companies, public companies here in the space globally, four of the largest companies, and we have, in particular, four of the best executives, strategic thinkers in this sector. So let's start right here next to me with Matt Schultz, the CEO of CleanSpark, and we'll go down the line.
Thank you, Mike. Thanks for having me. My name is Matt Schultz. I'm the co-founder, executive chairman, and as of a week ago, years ago with a portfolio of technologies on energy generation and distributed energy resource management systems. And we've evolved to become, I would say, one of the largest Bitcoin miners on US soil. We have 50 exahash of processing capacity. We have just over a gigawatt of electricity in our contracted pipeline with about 1.2 gigawatts behind that. And as Mike mentioned, similar to a treasury company, we sit on 12,500 Bitcoin that we mined all of those. So we've also grown to take opportunities to monetize our Bitcoin through different, we have a digital asset management trading desk. So I'm excited to be here, excited for the conversation.
Patrick.
Hi, Patrick Fleury, Chief Financial Officer of TeraWulf. We are a power and infrastructure company. We do both Bitcoin mining and develop high power compute co-location hosting facilities. We have about 250 megawatts of Bitcoin mining today at our Lake Mariner site. We did develop the first and I think only Bitcoin mine behind the meter at one of the nation's largest nukes a few years ago with Talon Energy. And we recently, last week, signed a deal with FluidStack and Google to develop 450 megawatts of high power compute at our upstate New York site. We have 1,150 megawatts total in the company. And I think unlike some of the other folks up here, our philosophy from day one has been we love Bitcoin, but we mine it and we make a profit on mining it and then we sell it. So we do not hodl. I know that'll probably be an unpopular commentary up here, but that's been our fundamental financial strategy from day one, which, like I said, a bit different, but big believers in Bitcoin and love this ecosystem. So thank you for having us.
Ken.
Ken Draper, Chief Commercial Officer at Iron. We're a next generation data center company powered by renewable energy. We have been focused from day one on multiple different use cases for our infrastructure. We've got over 3 gigawatts of secured power in the portfolio, currently operating across 3 different verticals: Bitcoin mining, AI cloud services where we own GPUs and provide GPU as a service style compute, as well as AI co-location at our data centers.
Salman.
Good morning, everybody. Salman Khan, I'm the Chief Financial Officer for Mara Holdings. Mara, from an exahash and market cap perspective, is the largest, one of the largest, and we have global operations here in the US and partnerships with sovereigns in Abu Dhabi and elsewhere. Our story has evolved over a period of time. Until beginning of last year, we were asset-light company, which meant that we rented rack space and deployed miners and hash, and as a result of that, we grew very quickly to be one of the largest perspective of having. And as a result of that, another strategy, amongst many strategies that we've deployed, is to own and operate wind farms in Texas, where we mine coins when the wind blows, and we stop mining when the wind stops blowing. And as a result of that, our cost to mine, marginal cost, is almost zero. There's some cost, but it's almost zero, which makes it ironclad against any kind of halving events. We are thinking very long term. In addition, we have also recently announced an acquisition of Exaion, which was a wholly owned subsidiary of EDF. EDF is one of the largest utilities in the world, focused on clean energy, based out of France. And that is an interesting development on our side. We have been talking and hinting about AI on the edge. We've taken a little bit different approach from our peer group when it comes to AI. We believe this is the right strategy for our stockholders, and we're very excited about that. Looking forward to talking more about it.
Great. Thanks for the intros, guys. So Bitcoin mining is often viewed as a very challenging business. At the halving, the rewards get cut in half. You've constantly got to be growing right into the cycle. This cycle in particular, the hash price has not risen as much as many of us would have liked. Do you view this as sort of a different cycle? Is this something you sort of expected? And how do you think you need to adjust strategically in order to address the challenges in the space? I'll start with Matt.
Yeah, so I would say that the 4-year cycle is effectively broken with the maturation of Bitcoin as a strategic asset with the ETFs and now the strategic treasury and whatnot. I think the adoption is driving demand. I mean, if you read anything about the most recent ETFs, they've consumed infinitely more Bitcoin than have been generated so far this year. So I think effectively that halving cycle is broken. Additionally, there's a shift as all of my peers will talk about, that the megawatts that we own, I mean, having over 1,000 megawatts operational or under contract, 800 operational, and another 1.2 gigawatts on the come, the demand for electrical infrastructure and the ability to rapidly build that out has shifted dynamically. A year ago today, we were here talking about the fact that we now have Bitcoin mining operations here in Wyoming, my home state. And the reason that we were successful in procuring megawatts in Cheyenne was because there was a need to rapidly develop and monetize those megawatts. And a Bitcoin miner can do that much more rapidly than a proper full-scale large language model data center. So our speed to market with the electricity has created opportunities such that now we can look at ways to monetize power beyond just Bitcoin mining. So it's allowed us some flexibility, but I think, beyond all of that, the support that's necessary for the Bitcoin network and having the distributed footprint that we have, I mean, with 33 locations, we now have a great deal more flexibility than we ever did before.
It's awesome. Patrick, you comment on Bitcoin mining? I know we've got a lot to talk about elsewhere, but.
Yeah, look, I think I may have a different perspective. I think Bitcoin mining is an incredibly difficult business. Right? If you just think about Bitcoin mining like any commodity business in unit economics, 5-cent power costs you $60,000 per Bitcoin, roughly today, right? So if Bitcoin's at 115,000, literally half of the price of one Bitcoin today, if you have 5-cent power, there you go. Then you add on top of that interest, SG&A, other company operating costs, right? So it's really hard to make a profit mining Bitcoin unless you have really low cost power. And when I look around, I think the challenging part to me about where we are as an industry is there's one massive provider out there who we all love and adore, and that's Bitmain. And Bitmain will continue producing machines, whether any of us buy them up here or not, because they're in line with TMSC and they'll get their chips and they'll build their ASICs. And I think they can probably build those ASICs at $5, $6, $7 a terahash. And if they don't sell them to us at 15 or 16, they take them and they plug them in the US, in Africa, in Russia, in Pakistan, and all over the world. And that's why network hash rate keeps going up and up and up, even though it might not be extremely profitable for any of us to mine a Bitcoin. And that to me is single-handedly like the toughest and largest problem with our industry, in that you have, if I'm buying a terahash at $16 a terahash, and I can tell you that I think I'm going to get a return on that investment in 18 to 24 months, Bitmain, who can produce it at 5 to 6 and plug it in, is getting that return in 9 months. And then everything from there is gravy. So I think that's what makes Bitcoin mining difficult. When you talk about Bitcoin price, you can't talk about Bitcoin price without talking about network hash rate. And so, as I look at it, I think Bitcoin price has to keep going up for it to be profitable, because network hash rate is increasing almost parabolically because of that dynamic.
But if Bitcoin goes to 200 or 250,000 and network hash rate doesn't rise as quickly, won't the mining business get really good for some period of time?
Absolutely. But like any commodity business, right, there's periods of time where the oil market over-earns and under-earns. So I think what we've learned, and I think all of us have learned up here, is you have to have a balance sheet and liquidity that can survive that. And you got to be positioned, again, to try to be the lowest cost producer so you can survive cycles.
And that's one of the benefits of layering in AI, right? To have some non-correlated revenue stream. So Kent, Iron has a 50 exahash Bitcoin mining business. The company signaled that it won't be growing that in the short term. I think the company originally believed effectively that Bitcoin was a great offtake for the energy and a good way to scale the data center business. Is that still the way you view Bitcoin mining today? Has anything changed in your thought process?
Yeah, I think as far as it relates to the actual Bitcoin mining side of the business and how we think about it, I'd echo some of the comments there. I think being a low-cost producer is fundamentally important, and that's how we've always focused our business, is having control of our sites, having operational control, being in areas that are low-cost power jurisdictions is incredibly important. Having an efficient fleet is very important. But if you can put all of those together, in the way that we think we have, Bitcoin mining is actually a highly profitable business. So to give some direct examples of that at the moment, and as Mike mentioned, we're at 50 exahash. That's $1 billion annual revenue run rate at current Bitcoin economics. Our gross margin, so that's revenue less electricity, is 75%. And if you include all of the corporate overheads and SG&A of the business, it's an EBITDA run rate of $650 million. So 65% margins overall for the business. We also like this asymmetric risk profile that you have, in the sense that if you're a low-cost producer, if you do get downturns with the Bitcoin price, all of the high-cost producers will drop out of the network. And that's literally just a marginal cost decision. If you're operating and your electricity cost is higher than the revenue you're making, you will just flick the switch and turn your machines off. That reduces the size of the network. And if you're continuing to operate as a low-cost miner, you get a disproportionately higher share of the Bitcoin rewards. So we like that downside protection as a low-cost producer. And then when you get these runs in the Bitcoin price, given the size of the network now, there can't be enough capacity added to normalize the profit. So you can actually earn outsized returns during those periods. And we do see, as was mentioned earlier, some increase in global hash rate over time in some of these very low-cost power jurisdictions in developing countries. But I think it's hard to add really material capacity in those places. It's very hard to raise capital. This is a capital-intensive industry. There's always a threat of regulation and nationalization of operations. So I don't see that as a major risk over the long term in terms of size of the network. So I think it can be very profitable. As Mike mentioned, we have put a pause on that for now, but that's really dictated just by the opportunity set that we see on the AI side today, and the potential to really diversify the revenue streams within our business, rather than a fundamental view that Bitcoin mining is no longer attractive.
Salman, are people too negative? Are investors too negative on Bitcoin mining?
Look, it's an open secret. This is a difficult business to operate, period, right? That's why you're seeing 4 of us talking about diversification. Having said that, I spent more than 2 decades in oil industry, and this reminds me of those trends in commodity exposed cycle industry. There are some very wealthy families in oil sector who made billions, and then there are others who have filed bankruptcies. And to Pat's point, you have to have a very strong balance sheet to survive these cycles. The challenge in this sector is that you have hash price, which hasn't improved. It has stayed static or deteriorated over time. And that is what Bitcoin miner depends on hash price. It's not just the Bitcoin price. And that's why we like the strategy of not just having Bitcoin mining at scale and being creative about how we mine Bitcoin, but also hold Bitcoin on the balance sheet. Now, we're not a treasury company. We're not MicroStrategy. But we like to have that hedge. If Bitcoin price escalates like it has, for example, the investment that we made last year by going into full HODL that has given us rate of return of 30, 40, 50%, depending on the price range that you look at today. And that kind of rate of return you won't find with investing in your Bitcoin mining operations or even AI. And the question is, how can you get that so quickly? Some of those investments are longer horizon. So it's a treasury decision for us, but it helps us from our stockholder perspective. It gives them that hedge against the hash price being low while we continue to hold Bitcoin that creates value for them. Now that's one aspect. The other aspect is, look, we have to be creative as a sector, and we've been quite vocal about for years that the traditional Bitcoin mining model after a halving or so may not be feasible. That's a reality. At 5 cents, 4 cents, 6 cents kilowatt hour, even if miners become much more effective, it will plateau over a period of time. And we have to be creative about it. So what we have been looking at is marrying intermittent power with Bitcoin mining. Just a reminder, our return on capital employed, which is one of the most important KPIs in my humble view in capital intensive businesses like us, and oil and gas and any other capital intensive industry, ours is 3 times better than our closest competition. And the reason I say that is it's an important element. You have to manage your capital, you have to deploy it properly, you have to have the lowest, try to get to the lowest cost, as Kent mentioned. That's very important. It has to go, you have to be able to survive in all cycle, bull or bear. But at the same time, investing has to continue in order for you to have a sustainable scale. Global hash rate keeps growing. If you slow down your growth lower than global hash rate, your difficulty level goes up, your cost goes up. And that's the reality of the sector. So you either sign off completely and say, hey, I'm not going to do Bitcoin mining, I'm going to do AI, or to be in the Bitcoin mining and continue with the pace, and while also diversifying your revenues.
So one of the hottest topics in the entire world right now is the shortage of power. You hear Elon Musk, Sam Altman, all these guys talking about how power is the real constraint to building out, large-scale AI, AGI potentially coming in 3 years. Bitcoin miners, legacy Bitcoin miners, went out and acquired a lot of power cheaply over the last 5 years. It seems like that's a pretty incredible opportunity, right, to convert some of that power. I want to start with Patrick on this because Patrick's company, TeraWulf, just announced a $6.7 billion deal with Google as a backstop on Thursday. Your stock has basically doubled over the last 3 or 4 sessions. And
Still cheap.
Yeah, it's maybe, right? Do you want to talk us through what happened there? I mean, that was the first time we've seen, this is something I've been saying is going to happen for a year or two, and you finally validated it, but we would see hyperscalers, Google's, Meta's, Amazon's, Microsoft coming directly to these guys on this stage because they need the power available tomorrow. And in order to scale their AI platform. So how did that deal come together? Tell us about it.
Last year, when we sold our behind-the-meter Bitcoin facility at Talon's 2.4 gigawatt nuke facility to Amazon, right? So Amazon's cost of capital is a lot lower than mine, and they wanted that power, and they want it for AI. So I don't think we'll ever see another Bitcoin mine behind the meter at a nuke as long as Amazon, Google, Microsoft, Meta, Oracle want power for AI. Because they have a much lower cost of capital than all of us do. But yeah, look, Mike, we're really excited. These things, as everyone can attest to up here, like electrical infrastructure doesn't move quickly. Tech is used to moving quickly and breaking things, but these deals take an extremely long time to come together. It took us, from soup to nuts with Google and FluidStack, 4 to 5 months of very intense due diligence. And then, getting I would break these deals down into 2 aspects. One is you have to sign a lease, and the lease is very complicated in and of itself. And then as soon as the lease is signed, the team turns to me and Solomon and the rest of us up here and says, how do we finance this? So for us, my job really with this transaction was allowing obviously the technical teams at FluidStack, Google, and TeraWulf to kind of come together, get a design that everyone was comfortable with, which really depends on what you're going to be doing at the site, and that drives cost. But then once we had that, trying to figure out, TeraWulf just last week was a $2 billion company. Now we're a $4 billion company, right? And trying to articulate and explain to somebody like Google, right, who's 2 trillion public market cap and only 30 billion of debt, how we're going to do that is difficult. And so I think what I take the most pride in that transaction was really working collectively with those partners to come up with a new mousetrap that I hope now becomes something that the industry can duplicate at other companies, where Google is providing 3.2 billion of backstop lease obligation support to TeraWulf, which effectively allows me to go out and secure financing at a really efficient cost of capital. Yesterday, we did an $850 million convert. That's 6-year money at 1% coupon.
Did that start as 400 million?
It started as 400 million. Yeah, it's the largest upsize in the convert market in 4 years. So really proud of that. But again, that's because we got the right mousetrap with Google. And Google now, with their 3.2 billion of support to us, that's over 10% of their balance sheet obligations. 2 trillion public market cap and only about 30 billion of debt. So getting a $2 trillion company, right, their management team, their board, everyone to sign off on a new and novel concept was not easy. But I'm hopeful that we've kind of provided a roadmap here, and now some of our peers up here will be able to kind of use that, because I do think the demand for AI is insatiable right now. And I think all of us are really positioned in a great spot to kind of capitalize on that going forward.
Well, congratulations and thank you, because it's a huge validation of everybody's megawatts. And I've noticed the stocks have been a lot stronger, even with Bitcoin trading down. I do expect more decoupling from Bitcoin as more companies in this sector actually transition more of their power to AI. Let's go to Kent next, because Kent's actually running a NeoCloud himself. I mean, CoreWeave went public a few months ago, 3, 4, 5 months ago. Stock went up 3x right away. They don't really own a lot of physical infrastructure. You're kind of coming at it from the other side, developing the infrastructure first, and then plugging in the GPUs. How do you think about co-location versus running your own cloud? Because very few people in this sector have decided to take that approach.
Yeah, well, I think we're in a unique position in that regard, that we do have the ability to play it from 2 different angles. And they are vastly different when you look at a co-location type model versus a cloud model. Capital intensity is very different. If you are owning the GPUs on top of the data center infrastructure, that's 3x the investment of just the data center infrastructure itself. If you're thinking about co-location, it's these 10, 15, 20-year contracts. Very steady revenue stream, effectively no recontracting risk because they're set term lengths, but much longer payback periods. So you typically see 7 to 10-year payback periods on the underlying infrastructure cost, whereas on the cloud side, the payback periods tend to be a lot faster. Typically around 2 years on the GPU investment alone, and then 3.5 years if you're taking the data center investment into account.
That assumes the pricing on the GPU hours holds up, right?
Correct. But I think if you believe the ultimate thematic, which was our original thesis from day one, was that the demand for compute moving forward is going to massively increase, and we're really seeing that play out in the market at the moment. I think both sides can be attractive, but those payback and returns that we're seeing on the cloud side today look particularly attractive, and I think the demand that we're seeing from customers on both sides is incredibly encouraging. And I would say it's there's a strong variety of players that are coming into this space, including hyperscalers looking for cloud compute, which is an interesting dynamic. And you're starting to see a lot more enterprise customers coming into that space as well. They're a little slower adopters than these AI startups that have traditionally driven the growth in AI compute, but they are coming more and more, and inference is going to play a more and more important role as we move forward, and that's where you're seeing some of this enterprise adoption.
So Solomon, Maris said you said you weren't going to do AI maybe a year ago, but here we are, things have changed. You did some M&A. Maybe walk us through your thinking on why you did that transaction, what your kind of longer term strategy is in terms of addressing AI. HPC.
Tap that market and create value for us. So we announced this acquisition of Exaion. Once the transaction closes, we will be 65% owner of that company in partnership with EDF. It serves the data centers in Europe and Canada. Currently, it's got partnerships with NVIDIA, Deloitte, and many other customers. It's got recurring revenues. Currently, it's a startup, but it's got recurring revenues that are out there for the current customers, and they're expected to grow over a period of time exponentially. The angle that we have on the AI front is compute on the edge, and we like compute on the edge, where you have, if you think about it, if I have to simplify for everybody, if you're ExxonMobil, Coca-Cola, PepsiCo, Saudi Aramco, or a hospital, you don't want your data to be mingled in a third-party data center site with everybody else. You want security around it, you want it closer to your location, and that's the piece that we like. We like to serve that market, which is currently very small, and it's expected to grow up to a 160, 170 billion mark in a couple of years. And that's the piece that we like. We like sovereign compute, which allows people to control their data better at closer location to them. We like the aspect of recurring revenues that come with that. We also like that there's a software aspect to it, and also the platform aspect to it. So platform as a service, which can include both GPUs or without GPUs and software. So it's a multiple angle that we're planning to solve, and the credibility that we gain by acquiring an existing sophisticated company that has built this around data centers that are nuclear sites in Europe and clean energy, that really is music to our ears. So that gives us the upside to not only do that right now, but also grow it and invest further and increase our investment or our equity in that company.
Matt, you've got sites that are near city centers. We've all been speculating that maybe you'll get into AI as well. What can you share with us about your current thinking on that?
So we take a different approach to all of our peers, but it's the same end result. And that is energy utility, but the fear that the lack of interruptibility at those loads causes them concern. And what we found is that by curtailing our energy consumption for 120 hours a year, we can avoid about 1/3 of our total energy costs. So being that flexible load matters. Now, to the point about AI, you remember back the first day of business school when they talked about the franchisees used to take to Ray Kroc the idea that we need to sell chicken. And Ray Kroc's counter response was, McDonald's is a hamburger place, we need more locations. So more locations, more locations, more locations. And then when they launched chicken nuggets, they were the largest seller of chicken in the nation overnight. So what we've been quietly doing is rolling up megawatts around the country in areas that are very strategic. And you and I have had this conversation before. A lot of the early movers that have sold or subleased or joint ventured on megawatts, in I think our collective opinion, have left a lot of meat on the bone. They maybe sold too soon. So what we've looked to identify are areas, and you mentioned Georgia. You know, we have 100 megawatts surrounding the Atlanta airport. So you want to talk about demand for captive energy. That's a prime example. We have another block in Norcross, Georgia. We have a lot of stuff in Tennessee. We have assets, here in Cheyenne. So we're we've been focused on being the valuable partner for some of these rural utilities to monetize stranded megawatts, give flexibility as they continue to add generation and capacity, balancing those loads because we are flexible. And then I think the next logical step that you'll see, and that our team, we've got a pretty sophisticated team of AI guys led by Taylor Monig. But I think what you'll see is that some of the infrastructure that we have that makes more sense and gives us a higher ROI per megawatt than Bitcoin mining currently does, we're certainly analyzing those very actively.
Great. Well, thank you so much, guys, for sharing your views on AI. Let's go. Go down the line with some.
In a commodity exposed cycle, there will be opportunities to buy and sell Bitcoin or shares, as day traders would call it. But we believe our company is surely undervalued today. If you do the sum of the parts analysis and look at the initiatives that we have, you add them together, the math doesn't work.
You have $6 billion of Bitcoin.
We do.
And you have a market cap of $6 billion.
Almost $6 billion.
But you have some convertible debt.
We do have that, but then we also have mining business with worldwide scale.
So you might say the mining business is effectively being valued close to zero at this point.
Yeah. So something to think about from an investor perspective. Obviously, this is not an investment advice, but from our perspective, we are fixated on delivering results because our value driver is going to be long-term value creation that comes with mining Bitcoin at scale, at effective, one of the lowest costs. Our cost power is 4 cents per kilowatt hour, which is one of the lowest in this sector. And then the scale is important. Global diversity is important, not just exposed to one state or two state. We believe expansion around the world is going to drive that value, while also cherry on the top, AI, which will continue to provide that diversity on revenues.
Ken, thoughts on the cycle and why should people consider iron?
I think, I won't comment on where we are in the cycle because who knows, but I think, as I mentioned, we're a low-cost producer. We have the best fleet efficiency in the industry. Operationally, we're doing very well. We mined the most Bitcoin of any of the listed miners last month. Very low cost of power, all of which means we have very high profitability on the Bitcoin mining side of the business, which gives us a great platform as we look to expand in the other verticals. And then on the AI side, if you consistently look around the industry, you will hear that the pinch point in this industry is around land and power. And we have over 3 gigawatts in the existing portfolio that we've announced, a lot in the development portfolio sitting behind that. And when you look at some of the people, particularly in the neo cloud space, Nebius, 200 megawatts operating today, 1 gigawatt secured, CoreWeave, 500 megawatts today, recently bought Core Scientific because they see the pinch point, and we think we're very well positioned given our portfolio to be able to play both in that space as well as this co-location theme.
Patrick, final thoughts?
Yeah, I'll be quick because it's pretty simple. We're partnered with one of the largest companies in the world. They have approximately 15% stake in our company. They're the largest shareholder. And I've contracted 500 megawatts out of 1.15 total gigawatts. So I have basically double the capacity offer. And I'm a CFO, so I can't resist. So I have to leave you with this. But if I contract all that up, really cocktail napkin math, it's $1 billion of EBITDA. Digital Realty, Equinix, big data center companies paid at 20 times EBITDA. So billion times 20, $20 billion. It's going to take me about $8 billion of debt to do that. That's 12 billion of equity market cap, and I've got 500 million shares outstanding. That is a $25 stock. The stock is at $9 today. It's still cheap, Mike.
I love it. Matt, final thoughts?
I think over the balance of the decade, Bitcoin is going to evolve from a speculative asset to a global standard for balancing energy networks. You know, CleanSpark has a uniquely balanced position in that we have all of this access to power. One of the, I think, top two with iron most efficient fleets. We have favorable energy costs, and we've developed a pretty big stack of Bitcoin that we own. So I think with all of that, and then the opportunity to monetize megawatts going forward to supplement that business, I think we're very uniquely positioned as well. And you know, as long as we're talking about value, we have just over $1.5 billion of Bitcoin and about $3.2 billion in net asset value and a $2.8 billion market cap. So we're on sale as well.
All right, guys, we're out of time. I'm going to make one final prediction. I do think Bitcoin's going to 150 to 200 by the end of the year, and I think that means everybody on this stage, their equity value is going to go up, maybe substantially. So that is investment advice. Thank you so much.
Good morning, everyone. Mass exodus. Unfortunately, going to miss the best session because of my guest today. That is Jenny Johnson. Jenny, I have to tell you, I know you're around ranches and horses all the time, but the idea of jeans and boots on stage for me, I'm like itching, but I'm trying my best.
I was in it yesterday, but I didn't want a photo.
So we only have less than 15 minutes, but I think this is a really important conversation that maybe is an exception to most of the day, which is a traditional asset manager and with their role, with their opportunities and with their ideas and the future of cryptography and blockchain and cryptocurrency mean for that TradFi. And you've been really a pioneer in that. So I want to take you back. We were on a park bench. It was like mid 2020. So you can imagine we were meant to be social distancing. I'm sure we were breaking all the rules. And I remember you said something to me that you've now been on the record lots of times and saying that every time we start talking about the opportunity in blockchain, it inevitably ends up in Bitcoin. And you weren't saying I don't want to talk about Bitcoin, but the problem was it was just distraction for what you called possibly the greatest transformation in financial services in a generation. Maybe I'm putting words in your mouth, but talk me through why that was such an early epiphany for you.
Yeah, so what I said was, look, Bitcoin is the greatest distraction from one of the greatest disruptions that is coming. Financial services. And I think in this debate about Bitcoin, which to me is like a religion at this point, right? You can argue whether it's real or not, it doesn't matter. And I have come to the conclusion that because it's a great fear currency, and when I say that, if you're from the US, you don't really think about this, but you travel internationally. And I remember talking to somebody from Israel who said, my parents and grandparents had their money taken away by the government. They will always keep a percentage of their savings in Bitcoin. And they're not going to put it in a Bitcoin ETF because the government can reach that, but they'll keep keys for their Bitcoin. And then talking to in Bitcoin. So that in my mind gave me like comfort around this floor. But the point on the blockchain was, it is such a, from a technical standpoint, and I ran technology for a while, it just, as a program, as a programming language, it does really important things, right? And these are things in financial services that are going to be significant. Anybody who's run a financial services company, we spend a ton of money reconciling data between systems. Boom, that goes away, right? There's this batch process, all these products and back office are, because we're sitting there's a bunch of mainframes. I'm pretty sure every major bank out there is still running a mainframe, and you batch process. And so why does the New York Stock Exchange close at 4 o'clock? It closes so everybody can reconcile. What Bitcoin does is you have atomic settlement. So you're going to settle immediately. And then the final piece is you don't have to worry about who the counterparty is on the other side. When we do an FX contract, we'll use a major bank because we don't want to know, we don't want to worry about whether we're going to get paid for with that counterparty. But if you have it in blockchain, one, because the token can prove ownership. Two, you can get paid immediately, so you have atomic settlement. And three, the smart contract can execute it without people interfering. You actually don't need that intermediary. So that drives down costs. It's more secure. And I was talking to Anthony this morning. He said, well, what about quantum computing? Remember, when you worry about quantum computing, you're also going to have quantum security to offset it. So I feel like that will evolve with it. You have transparency. Regulators are going to love it. For all that they're afraid today, they have tremendous amount of transparency, more than they ever, and you add AI to that, and it's going to be a great way. They're actually going to, they're going to fall in love with it. Efficiencies like atomic settlement. And then finally, operational cost efficiencies. Like in the asset management business, there's only one way fees are going, and that's down. So we have to constantly evolve to be more efficient. And so it's going to open up, it's going to have cost savings, and it's going to open up a bunch of investment ideas and opportunities that people haven't been able to use today because of the technology.
So Clayton Christensen, good Salt Lake City boy, where I live now, of course, has the famous innovator's dilemma theory. And I'm curious, in your boardroom, in your executive team, and just you as a leader thinking through the reason that traditional incumbent firms struggle with change, disruption, innovation, is that there are real revenue disruptions. There are real risks. You are creatively destructing your own business, which is extremely difficult to do for the benefit of the future. How have you led through that and even managed your own fear?
Yeah, so I actually think this is one of the issues or one of the challenges of public company CEOs. So first of all, I'm third generation. My grandfather started Franklin Templeton. So I do tend to think generationally. Like, I don't want to be the one where they're like, man, we had a really great thing going until Jenny missed that obvious trend, right? And so you do have to think and balance it with what has to be done today, right? And so I think that's every CEO's challenge. And the reason I say the public company is tough is because there's so much pressure on quarterly earnings. And the work, we started doing stuff in blockchain in 2017, 18. We launched our Benji tokenized money market product in, I think, approved by the regulators in 2020 or 2021. These are not going to be meaningful contributions to our earnings probably for 5 years from when we started or more. You know what? Most CEOs are going to say that's the next guy's shift.
Yep.
I'm not going to make this investment today because I got to deal with the quarterly earnings. So that's one mindset that I think that's why private companies often can think a little longer. And then the second piece is, so then when you have these folks who are really excited about this technology, by the way, they tend to be really disruptive to the rest of the firm. The rest of the firm's like, yeah, that's all great, but I got to get my sales numbers now. I need to get, the NAV done at the end of the day. I'm not going to talk about that stuff. And so you have to almost, and we're doing it. With AI, you almost have to.
So let's talk a little bit about this laboratory. You mentioned Benji already, which first 40 Act.
It's tokenized mutual fund that is on the public blockchain. It's the only one on it. We are running it on the public blockchain.
Okay, and you've been talking with MAS Singapore, I've seen in the public domain as well. About down the road, what's the roadmap from here?
There's a lot. I mean, so I genuinely believe that mutual funds, ETFs, all happens, right? When I use that foreign exchange, we pay big banks a lot of money to execute a foreign exchange contract. As you eliminate that, you could drive down the cost. A couple things you could achieve. One is our tokenized money market fund. You can subsidize this. The larger investors don't want to subsidize the small investors. That doesn't happen when you put it on a really efficient rails. And so I think that it's gonna naturally happen to all the traditional products. And then it opens up new investment opportunities, because you take out the frictional costs, you can start to create, song rights. I love the Rihanna example, didn't really work that well, but there will be these types of things where, she issued 300 NFTs, each worth 0.0003. She issued 300 NFTs, each worth 0.00033% royalty, the rights to the Bob Marley, library of songs and things. And so there's going to be a lot new interesting products. And then this atomic settlement. So with Benji, we're a regulated money market fund. We have filed it in every jurisdiction. We also have a private one too. We're working so that you'll be able to move from stable coins into the money market fund, and you can do that to see that happen.
Rihanna is your ringtone when you call me. You realize it. Can we dream even farther, though, when we talk about tokenizing mutual funds, ETFs? What about, you talked about the friction of the 4 o'clock close for reconciliation. Do you foresee a world in the short, medium, long term where public equines, public treasuries?
I'm pretty sure Brian Armstrong at Coinbase has been talking about this. I think he did it in Davos when we were on a panel. And why not? All he has to do is hold an inventory. It's almost like an ADR. And you could trade 24/7. There's already after hours. Why wouldn't you want to trade and get atomic settlement? Why are we waiting T+1, T+2? It makes zero sense. And we're waiting because the infrastructure doesn't support it. But naturally, I actually think that as the regulation clarifies, right, because that's been the key, as the regulation clarifies, those that have the digital assets will start to offer more traditional types of products. And it'll be 24/7, 365. Mm-hmm. And, I don't know how fast that comes. I think regulation, the technology exists to do it. Regulation is probably the biggest inhibitor to that happening today quickly, but it's happening. It's going to happen.
So let's finish with that. So I imagine most of the speakers that you're going to see through the course of the next day and a half, this regulatory legislative environment is existential. It is very acute, as you heard from Kraken earlier. For someone like Franklin Templeton, clarity and liberalization around the regulatory structure, how does that change what you're doing? Does it accelerate some things, not others? Does it give you more comfort? Or does it not change anything that you're doing?
We're a highly regulated entity, so we've got to play by the rules. Now, that's been at times frustrating because I think it's in trying to do that, because we don't want to risk the rest of our business, we've allowed these unregulated entities to take off, right? But if you actually put yourself in the shoes of a regulator, guess what? There's no upside to getting regulation right. Nobody goes, hey, that guy was really ahead of himself, right? But by the way, if you get it wrong, you are literally crucified. Everybody complain, you should have known, you should have seen it. And so, unfortunately, regulators are not in the position to take a lot of risk on where this is going. And let's face it, there are a huge number of digital assets that even all of you in this ecosystem will say, I don't see it. That is going to blow up at some point. And so if you're a regulator, it's so hard to define the rails to be able to deal with that risk. And that's why I think it's going to be slow. And I think the good news is you see, we've worked a lot with regulators all across the globe. And I would say, they've taken different approaches. Like an MAS in Singapore has a sandbox. So as long as you're working within it, you're protected, but it's not something broader than that. Hong Kong has been very aggressive on trying to be very prescriptive. UAE, same thing. And so there's a little bit of competition with each other, which I think is healthy. And they are also talking to each other to learn from each other, which is good. But listen, I don't envy the regulators because I think this is it's a bit of a challenge. And on the other hand, if you don't start to regulate, you put the consumer, which is who you're designed to protect, at risk because the consumer is now entering a completely unregulated zone. And that's not a good thing either.
Yeah. So very last thing, for the investors out there, is there, and you can't say Franklin Templeton, but is there any category?
Who says I can't?
Any category of this ecosystem as an investor that you think is the most exciting? Tech layer, killer app, infrastructure, picks and shovels. What is the most exciting area?
Yeah, I mean, look, I think, you know, the picks and shovels and sort of the baseline of the strong, you know, layered apps, like like you always, if you were mining for gold, who made the most money? I mean, there were some people who made it in gold, but most people, it was the guys who sold the picks and shovels. So I like the rails as a sort of starting point. And then there are some really great consumer apps that are coming out that I think are really interesting, which, by the way, I tell my equity guys, like, you should pay attention to this area because some of these companies are going to disrupt, you know, and you're only looking in the ecosystem of sort of the traditional, and there's going to be disruption to those companies. And so, and then final thing, you know, we're a node validator, and I think public equity, all the transactions that go in and out of that company and how much information that gives you. And so we, you know, provide research on, I think 30 different coins. And our view is if you are not playing in the ecosystem, you actually cannot possibly have the insights and so that, again, that transparency point, it's pretty amazing to be playing in that space.
Well, that was a whirlwind, unfortunately, Jenny.
I didn't
Thank
fast,
you so
man. I
much.
was
I wish
watching
we
the
had more
clock,
time.
but
It's
like-
red already, but let's give Jenny a round of applause.
Thank you.
Welcome. Thank you all for being here. I'm Sean Ford. I'm very excited to have the honor of having a nice conversation with these four battle-tested professionals in the crypto space. And we were joking beforehand that of all the panels, I mean, if you wanted one where you could kind of count the scars, this one has plenty of them, and I think well-earned. So I want to just give a chance for everyone to introduce themselves. Maybe we'll start at the end with Carlos Domingo.
Sure. I'm Carlos Domingo. I'm the CEO and co-founder of Securitize, a company that focuses on tokenization of what they call today real-world assets, which is a newer term in the industry. So we've been doing this for a very long time, and we primarily focus on serving the large, traditional asset managers to bring them on chain through, the licenses and the technology that we provide.
Great. I'm Carolyn Weinberg. I'm the Chief Product and Innovation Officer at BNY. And as part of that, digital assets is a key part of our strategy, enabling the ecosystem of digital. Prior to that, I was the Chief Product Innovation Officer at BlackRock, where we did quite a lot in digital assets that I led with many amazing partners that you probably know. Prior to that, actually, was in the sales and trading business. I ran fixed income derivatives businesses at various firms, so know very well the collateral markets, which we're going to talk about at some point. Prior to that, I worked at McKinsey, so take a very strategic mindset to all the things that we do, and I'm very excited for this conversation. Thanks for having me.
I'm Walter Hessert, the head of strategy at Paxos, and at Paxos we are building regulated blockchain infrastructure. We power a lot of the largest enterprises in the world with their blockchain solutions, whether it's Bitcoin trading and wallets, stablecoin orchestration, and of course stablecoin issuance, which we've been issuing various stablecoins out of our New York Trust and other regulated entities going back about 6 years. And today we issue a handful of different stablecoins, always operating at the infrastructure layer, one for PayPal, PYUSD, and USDG for the global dollar network. And Paxos is always really focused on being regulatory first and focusing on the infrastructure layer serving large enterprises.
Hi, everyone. I'm Nathan McCauley. I'm a big fan of Wyoming. Spent the last week in Yellowstone, so enjoying it. When I'm not vacationing with my family in Yellowstone, I run Anchorage Digital, digital asset custodian that builds a bunch of infrastructure for institutions to participate in digital assets, whether that's on custody, trading, stable coins, or settlement. And so we have a whole suite of offerings that allow institutions to either directly participate in the digital assets ecosystem or build on top of the infrastructure that we provide for them.
That's great. And so I'm Sean Ford. I was one of the founding team members at Algorand and have launched a new project on Avalanche a couple of months ago that's in the digital asset and yield generation space. So just to start this, I know there's been a lot of talk about the recent legislation that has been passed, which has provided, I think, some degree of sure footing for all of our businesses. I want to push past that because I think everyone here would probably agree that's a minimum requirement to having the United States in particular start to take its place in the stage as a leader in blockchain and crypto. But putting that aside, what do you all think is the next big barrier to adoption?
Sure, I can kick off. I think with regulatory clarity in place, one of the things I think about is that the Oldsmobile first started building cars, and when they designed the cars, Ransom Olds, the founder of Oldsmobile, figured out that he had all these wonderful cars, but there were no roads, and that's where I feel like we are now. We have the product, we have the regulatory clarity that we can deliver these services, but we don't have any of the roads. So much infrastructure needs to get built, integrated into financial services and into fintech, into the tech companies. And so that's really the stage that we're at now, right now, where like the car has been invented, but we need a bunch more roads to come into existence.
Carolyn, what do you think, based on your background, sort of spanning both sides of the
Yeah, absolutely. I think so at BNY, we are the financial infrastructure today for the markets. I think as many of you know, we are one of the largest custodians or the largest custodian, as well as we do 2 trillion in payments and so forth. And why I'm excited of the work we're doing at BNY related to blockchain and digital is that we're taking traditional and looking to the future. And I completely agree with Nathan. The future is very much about actually enabling that whole ecosystem. It's not just about one thing or another, it's about how the systems fit together. And that's how actually our financial system works today. So that's a huge hurdle, if you will, but it's also where when we see the mainstreaming of digital and a lot of the banks and a lot of the regulation coming into play that enables us to all do that, those rails going digital will enable us to actually scale. I would say one thing from talking about battle scars earlier, is that we need to make sure that we're doing this in the right direction. So we set the foundation for acceleration. The biggest hurdle will be if there's like a real failure in the system, we go too fast or we expect something that doesn't actually work. So I would just say we should be really thoughtful, think through all of the different second order effects as we have make sure that we are protecting the future by not doing things too fast, but going at the right speed for that acceleration.
I just think that part of the problem for adoption, once things like, the Genius Act has passed, so stable coins now are kind of legal tender, and you have more clarity about tokenization, etc. It's also kind of like abstract the technology out from the users, right? So if you remember, in the 80s or early 90s, when you had to connect to internet, you had to download a TCP/IP stack, and then you have to download the modem software, and then you have to click and then wait and then connect to internet, and you have to do all this stuff to be able to access the internet, and that worked well for the early adopters. And in crypto, we're kind of there. Like if you want to use crypto, you have to download a wallet and figure out how to activate it, and then sign transactions and deal with the horrible UX for, moving things across multiple blockchains because you don't know which one you are. And at some point, these technologies need to be kind of like abstracted out because BNY provides you a digital wallet, and it's there, and you don't have to deal with these things, or the phones already have the wallets there, and then you open your phone and your phone is connected to a blockchain, and you don't have to deal with the connecting it, etc. And until that thing happens, the mainstream users, of course, they will be the more sophisticated tech users, early adopters, etc., that will go through these barriers. But to go really full mainstream, you need to abstract this out from consumers.
Yeah, I think like, Carolyn, you've been at the helm of two of the pioneers in the space. And so, they have plenty of battle scars, as do we from the industry side, from the digital asset industry. I think that the reality is that for like every BNY, there's another dozen, the mass market that, you heard a lot in the market. Oh, we don't want to be first, we want to be second. But really what they meant is we don't want to be first, we want to come after like, it's all clear, the regulatory, regime's in place, the legislation is there, and like, first has been out there long enough to take all the battle scars. And that's just now. That is now. And so I think everyone in the market, no matter where you sit, whether it's on the regulatory side, whether it's on kind of the incumbent financial services banking side or in the digital asset space, I'm sure everyone is feeling the same thing, which is like everyone is now moving. You just have this wave of investment in this infrastructure, in this adoption. And the industry does continue to grow. It's growing every day. It's just we're talking about what makes it grow orders of magnitude more. And that all kind of happens together, and this wave is one of the big catalysts.
So can we stay just on that for a second, Walter? So Paxos has applied for, is it a registered charter? Banking charter trust license, is that what it is?
A national trust bank from the OCC.
Right. And so do you see that as and you're the third, sort of crypto-based or crypto-native company to really do?
Well, there's one now,
right.
That's Anchorage.
Right.
And we hope to be the second.
I was coming to you after this, Nathan, but thank you. I appreciate that.
Good friends. Thank you,
yes.
Walter.
He started to squirm a little bit.
Yeah, that's right.
Got it.
So I guess both of you then can comment on this. Do you see this as the start of a breaking down of the walls between TradFi and DeFi? Like this type of action?
I think breaking down the walls, that is a fair way to put it. I think that it really is going to advance the technology in the industry in a way that benefits kind of all, really lifts all boats with the condition of like boats that are willing to be innovative and move with the market. Yeah. The market's moving. The market has already spoken that like there are aspects of crypto and blockchain and digital assets that it wants. We have built businesses that are kind of natively built to serve that demand in the market. This allows us to operate at a much higher level and serve larger enterprises and more mass market. At the same time, you have all of the big players that are incumbents, and they have massive platforms, they have massive AUM, they have massive customer bases and brands, and they're going to innovate too. And in some ways, they've even been, we may have like felt it in a different way because we didn't have an incumbent, successful business, but in some ways they've even been held back more by the lack of regulatory clarity than us in the digital asset space.
Nathan, do you have anything?
Yeah, I mean, I would just think of, I think it's telling that we have BNY here on the panel with us. BNY is probably the best example of adopting technology for the entire history of banking within America. And so this question of is TradFi going to break down the walls between DeFi? I think these two converge over time. TradFi becomes DeFi, DeFi becomes TradFi. We had uncertificated stocks for many, many years, and then we moved them onto ledgers and got to faster settlement. And I think that we're going to see the same thing in digital assets. Another thing that I think is going to be really interesting here, I think it's at least poetically beautiful to me that the OCC was actually established by Abraham Lincoln to figure out how to bring the dollar into a common understanding of what the dollar should be within the US. And now with the Genius Act, the OCC has been given that charter again to decide what are the regulated stablecoins, how should the large, thoughtfully built stablecoins actually operate. And so there's echoes of the original reason the OCC was established in the late 1800s. They're now present today in its expanded remit.
That's great. And I just want to point out that you've now had Oldsmobile and what happened with that, and now you've talked about Abraham Lincoln. So there's a high hurdle for all of your references.
I'm going to be here all day.
Historical.
I got more.
This is
Let's keep going.
To keep it spicy. That's right. The Rough Riders next. So if we could, I guess I'll just ask what your opinions are around the shift of stable coins, at least as I've seen them, or digital assets have been sort of side projects. They haven't really been core to strategy. Stablecoins in particular have been interesting things that a number of pioneers have sort of taken the lead on, but have not become core. Do you see the strategic discussions shifting now where when you plan your strategy or where you see people talking in the market, is this CFOs now saying, I need to sort of plan stable assets and stable coins as I go forward?
Yeah, maybe
Sharon,
I'll, so as like head of product from BlackRock and head of product at BNY, sometimes we think about like beautiful products, but actually no one's going to use them. And I think when we think about the evolution of stablecoin, it's one of those things. Like, how can you use it? And how can you actually take the structure of the fact that in many ways, if you break it down, you have a tokenized money manager of treasuries, someone's holding those treasuries. And as we talk about interoperability, ultimately you just have treasuries moving around if you're going from one stable to another, or actually treasuries are staying somewhere and you're moving. So it's very similar in many ways to other things that we have. But the question is, like, why do you want to do that? Why do you want to move money fast around the world? And there are so many amazing use cases for that. And the question is as you start to look at the pools of assets and these important use cases, whether or not you're a CFO or trying to manage your money from a company perspective, gosh, wouldn't it be nice if I had one account and didn't have to have revolvers all around the world to support my working capital variance of risk. So if you can reduce that time period, you're actually adding value. So capital efficiency, liquidity, speed, all of those things can enable stablecoin to grow. So the coin's out there because, again, it's about treasuries, it's about tokenization, and it's about money management in a way that's really smart to make this. System work.
I think that because you have to move two ledgers, right? You have to update the ledger that tracks the securities, the ownership of the security, let's say a treasuries or a money market fund, but you also have to update the ledger that tracks the dollars that are the counterparty to the transaction, right? And then the fact that now we have this single ledger technology that uses the same underlying representation for dollars and securities is a huge advantage. And when I started doing tokenization, stablecoins didn't exist. Like USDC was launched in 2018. Tether was $3 billion, I think, AUM, and it was in the tokenized money market fund project at BlackRock. And then the advantage of that money market fund, tokenized treasury fund is that you also have stable coins as a counterparty to the fund to be able to invest and to be able to redeem the fund quickly, right? So one without the other are handicapped. And I think now that we have stable coins that are, legal, and we have also clarity towards about tokenization, the role of transfer agents and broker dealers for custody, et cetera, then I think that this is when the market will really expand.
Right. What about you, Nathan? You've called it, Anchorage has called stablecoins core plumbing.
Mm-hmm. Yeah, I think it's kind of interesting to think of whether they are core or not. Certainly, if you're looking at it from the TradFi angle, the stablecoins are not yet core. They're kind of the new up and coming player. But if you actually take the orientation of looking from the blockchain space, right now, over half of blocks mined or staked or added to each of the various blockchains that are popular are at least one part of the transaction is denominated in a stablecoin. And so they are actually the main way that blockchains are being used right now. Majority of the block space is toward stablecoin related transactions. And so, I mean, within tech, the never-ending story of tech is when you see something that is 10 times better than the existing infrastructure, it is almost guaranteed to succeed. And anybody who has touched stablecoins, anybody who's transacted with stablecoins, anybody who's moved stablecoins understands that they are a 10 times better dollar. And that's not to say that they're worth $10, but they are way more useful, way more convenient. And when you start to see these things, you realize there's a certain inevitability that comes to the adoption of these kinds of things.
The 10x kind of like paradigm does like create a interesting adoption dynamic where you have some of the largest platforms, the largest businesses in the world that have very global platforms market, and it's an internal ledger move for us. It's like if you get the tier down, then they're like, this really impacts our business and we get it, and it has to be core because this is going to save us a lot of money. And then what happens is that then brings it, you know, to the end customer. The end customer demand grows, and then those big platforms say, hey, now our customers want it, or our customers are going to want it, and so we have to start making it core to our operation. And so it really is an ecosystem. You can't point to like any specific thing that is driving, you know, kind of how enterprises and how the different institutions that are adopting it, how they're valuing it. It is really across an ecosystem watching this huge adoption wave take place and driven by a bunch of different factors and different value propositions for different cohorts.
So I'm going to ask Carolyn another question, which is, I think, so BNY has just been selected to custody stablecoins. Can you talk a little bit about how that process evolved and, you know, what your experience was in the decision-making around, you know, taking that step?
Sure. So for quite a while, we've been enabling stablecoins, Circle and others. The announcement, I think, is Ripple, Open Eden recently as well. What we're really focused on is the enablement and the ecosystem. So how do we actually think about this concept? We said there's treasuries underneath. You need bank accounts, you need payments. So all of these things we do to enable the stablecoin. We sort of inside, we call it stablecoin in a box because we actually can enable all these things, and we have lots of partners around that do much of the pieces as well. And together, what's important is that this is about better rails, and I think Nathan said it as well. We really, if there's a pain point, if you will, for a client, how can these rails enable that? So from our perspective at BNY, what we're really focusing on is how do we enable the stable coins to actually save our clients money, to create better, cheaper, faster ways, reduction in capital and these efficiencies. So that's one really important thing for our clients. And the second thing is the role we play in this central position. Our vision is that by being the custodian and the enabler and manager in some cases for the treasuries of these stable coins, we can ultimately in a future state interoperate between all of them. And that interoperability, imagine a world where you have treasuries in one stable and treasuries in another, all sitting at BNY. It's a book entry in many ways. The question is, how do you have 24/7 treasuries? Or if you have a cash account and a cash account enabling between inside BNY for the tokens to move 24/7 and the underlyings to move 24/7, that's what we're focused on. So what we're comfortable with is enabling our clients who are stablecoin issuers, who are settlers of transactions. We have 55 trillion in assets in custody. Imagine if all of those wanted to trade on blockchain within the BNY network or outside. That whole system, if you will, can be enabled through BNY. And that's what we're focused on. So hopefully that explains it. But imagine if there are loads of stable coins and everything could just move in ledger within BNY from treasury to treasury to treasury, from one to the next. That's what we're focused on. That's what we're trying to help, and to scale stable coins and then yielding coins, if you will. So Carlos brought up a product that exists that's yielding of stable coin. It's the same investment guidelines as a stable coin, but actually gives yield. So imagine just going back and forth, checking account, savings account, checking account, savings account. Ultimately, we would love to be able to do that for the system. And that's how we're comfortable.
And that's the premise of Liquidity Direct.
So what Liquidity Direct is a great point. Today, we are the largest enabler of loads of money market funds. So any institution who wants to put large amounts of money into a money market fund or switch between them, they do that through Liquidity Direct today. And what we've enabled is that some of these very large money market funds, they have share classes now that we've tokenized. We've done that in partnership with Goldman Sachs and some others. And the key is that A stable NAV money market fund that is a share of hundreds of billions of dollar money market fund, that's actually quite a nice payment rail as well. So we can think about tokenized deposits, tokenized treasuries, stable coins, and tokenized money market funds. All of those are great payment layers on chain to enable this instantaneous. And again, the faster we can move the underlying, again, if it sits in BNY, we could in theory move from A to B instantaneously. Therefore, we sort of see how it all fits together. And that's what the money market fund tokenization concept is. We talk about walking before running. For those who see those brand name money market funds, including our own Dreyfus, BlackRock, Federated Hermes, there are a whole bunch of them that we announced in partnership with us. That gives the credential that traditional players in money market are willing and happy to enable this in the digital space and see the value. That's what that was about, and that is what that is about.
So, Walter, you had made a comment, sort of offhand, that Paxos was sort of, I'm going to paraphrase, regulatory forward and always has been. Talk a little bit about that approach, because that was a challenging thing to be when there wasn't clarity in the space. And I think we all probably were wondering, are we going to trip a wire unintentionally here without that clarity? But talk a little bit about the responsibility maybe that Paxos saw it had to always be trying to filter in that regulatory responsibility as you built out the various assets and various capabilities that you had.
Well, we had the vision early on that, you know, we would get to this stage of adoption and, you know, ultimately, you know, far beyond this, which we have more conviction of today than we've ever had. And that is going to require specialization, and it's going to require specialization at all different levels of the stack, as opposed to if you go back like 10 years ago, what did crypto companies like at that time look like? They were doing everything. We were a custodian, we serve retail, we serve institutional, we have an OTS, we have a tokenized this, we have, you know, and that was what the businesses look like. And as the business matures, there is a need for specialization, and we always have been interested in building kind of modern financial market infrastructure. And so to focus on infrastructure, which that, to your point, didn't feel like a very smart thing to be doing back in, you know, 15, 16, and 17. And it felt very painful to be doing in 22 and 23. You had to go and be regulated. And so at Paxos, we've always seeked the highest level of regulatory oversight. And then we've actually operated our products out of those regulated entities. And that's important because, you know, especially when you're serving the retail markets, it's very like marketing forward. And so there's a lot of regulatory association, you know, still in the crypto ecosystem of people saying, I'm applying for this, you know, charter or this license, or I have this charter and license, but they might not even operate the business through it. We've always operated our businesses through these regulated entities. And that's not just so that we can, you know, boast about it and, you know, or take the different, you know, types of brain damage and scar tissue that comes along with it. It's because that's allowed us to serve enterprises. Yeah. And you look at our customer base today, even just look at the public companies that have chosen us as their infrastructure. It's over $1 trillion of market cap of companies, from MasterCard to PayPal to Nubank to Mercado Libre, Interactive Brokers. And the reason that they can do that and have the trust in Paxos, one of the important dimensions of that is the regulatory oversight that we come with.
So Nathan, you must have a similar take on this, is what I got to imagine, because you're coming at it. It's funny because the panelists up here have all come at this from a different direction. I want to talk to Carlos in a minute about this topic, but do you have anything to add on to what Walter just said about your experience?
Yeah, I think you know, in many ways, Paxos pioneered the idea of regulatory first. I think you guys were one of the first, if not the first, trust charter within New York. And we very much agreed with that thesis, that the way to build to last within the digital asset ecosystem was to pursue regulatory clarity, even when it's hard, even when it was difficult. You know, many large institutions said, hey, we want to be second. And there's a really good reason that you want to be second, because the ones that go first get in trouble. They have a lot of problems. They go through the growing pains. You talked earlier about the scars. But I think what we're finding is there are an entire set of institutions that would never have touched crypto with a 10-foot pole. You know, BNY, relatively speaking, had a lot of courage to decide to get into crypto and crypto businesses when they did. Similarly, BlackRock and a lot of the other institutions. But what we're seeing now is super conservative institutions say, hey, we can no longer wait. We can no longer stand on the sidelines of this. We need to come in. And so we're finding is that despite the fact that it feels like there's a regulatory lifting, what's happening is there's an even bigger set of institutions that are now coming in that want to work with the most regulated institutions that they possibly can. Because absent that, they were never going to come in the first place at all. And it turns out that is almost like an iceberg in a sense. And the iceberg of conservative institutions that are now coming in, I think is going to be really one of the main stories of the next 24 months.
Yeah, I think that's probably right. I want to go down to Carlos because of all the people. One of the things I've known Carlos now for
for a long
time. Carlos had hair when I met him, so a long time. And I've always been a big fan of securitizing. You've been particularly fearless in the RWA side of things with that lack of clarity. I wonder if you could just share a little bit about what kept you going amidst this lack of certainty and this great opportunity that you saw with RWAs and securitizing. Maybe walk through a little bit what that experience was like for everybody.
Look, we started in tokenization arguably way too early. And if I had to start again, the thing that I would have done is not start at that time and start like 5 years after. Because as you know, when we started, I think everybody had the same vision that, ultimately capital markets is about updating ledgers and moving things in ledgers. And, blockchain is obviously a much superior ledger technology. And there is no question that this will be adopted at some point as the infrastructure of the future. The question has always been, when, not whether it was going to happen. And then we were way too early. And what kept us going was, I think, three things. First, we've always made, incremental progress over the years. So you always see that things were slightly more happening. And then we got a transfer agent license first, and then a broker dealer, and then an ATS, and then all the things like that. And then we started working with, KKR first, and then Hamilton Lane, and then BlackRock. And we've always made progress, and not as much progress as we've made in the last 18 months, but, definitely, things were moving alongside. So that's one thing. And the other thing is obviously that we've always had a core group of investors that really believe in the mission of what we were doing and continue supporting us over the years until now we're profitable. So now we don't have that kind of problem, but you have to have the financial support to keep going and building, as Walter and Nathan know, building a regulated entity is much more expensive than, playing regulatory arbitrage like some of the people in my space unfortunately do. And then going and issue, unregulated assets offshore just to, bypass regulation. So we've always had the vision that we have to, be regulated. We have to operate out of the US. The US is the largest capital markets and the most sophisticated in the world. And, this is 40% of the entire capital markets, but the other 60% very quickly declines in like quality and attractiveness. So if you want to build a business, it has to be done here, no matter how difficult it is. In my opinion, it's very funny. We have competitors that are building global markets that exclude the US. Well, that's not global by any metric, because if you build a global business, it has to include the US. So anyway, I think that we're in a point where a lot of the uncertainty we've had in the past, that, by the way, it was uncertainty, but allow us to operate anyway. It is now gone. And as Nathan was saying, these will allow very large, very conservative. So.
I think liquidity and other things, but the idea that you can just tokenize any real world asset, it's a really important distinction. Like liquidity doesn't come just because you've tokenized. You can create an ETF of anything, and it doesn't mean that people are going to buy it or that there'll be liquidity in it. And I think that distinction is really important, and something that I very much appreciate that Carlos and team are very focused on. Because again, as a system here, what's important is that we all sort of work towards that system. It's the flywheel of the system that will enable blockchain, digital, and stable coins and all these other pieces to actually fit together to have a faster capital markets and enable the access and democratization of those real world assets and funds that are out there in the tokenized space.
So we have about a minute left, so I'm going to pick on you, Nathan, for this one.
Sure.
If we were having a beer, just the two of us chatting, what's the one thing if you were going to share with everyone that if you could have done it differently, you would have?
Oh, this is hilarious. I wouldn't have. This is it's way too hard.
Wouldn't have done it at all.
Yeah, it's I mean,
That's awesome.
I was
All
doing
right.
a investor reference check on these two founders that are looking to start a digital asset bank. And what I told the investors, like, listen, I think these guys are just naive enough that they might actually pull it off. Because if you actually knew how hard it was, you actually knew like how difficult it is to go through the process, particularly of becoming the first one to be regulated in a certain area. It's just very, very difficult. There's probably better ways to spend your life. So I think if we were a few drinks in, that's probably what I'd choose.
That's great. All right. We'll have to see what else we can get. Anyway, thank you all to the panelists. Thank you all for being here. Thank you, Salt, for having us.
No.
Oh, you really can't see anything. Okay. Is somebody going to announce us? Isn't somebody gonna... No? Okay, hi everybody. Fireside chat we have with SEC Chairman Paul Atkins. So much to cover. It's going to be hard to cover it in a short period of time, but we'll see what we can do. I know he doesn't need an introduction, so welcome back, Mr. Chairman. This is your third act here at the SEC, and we are so thrilled to have you back, much more so than the third act of your predecessor. You know, I think the first act from him was enough, but we are so delighted to have yours here. And so it's a new day at the SEC, and you've been saying that, and I just want everybody to be able to hear from you about what that means to you.
Well, it is a new day, and especially for this industry, I've been in and around it for a while, obviously, and so I feel your pain, and just some of the heard about debanking and other sorts of things. The lawfare that was being waged over the last few years is even more than I imagined. And so I think obviously we've changed as far as our approach goes. We're no longer a head in the sand, which has prevailed for a while. Hoping maybe that crypto would go away, and then after that came the regulation through enforcement, and so we saw how that went. So now it's different. Now we're about innovation. We want to embrace innovation, and historically the SEC, frankly, has not shunned innovation. It might not have been at the vanguard of kind of being the cheerleader for it, but it didn't stop it. And so going all the way back to like the 1960s, there was a big bull market there in the United States equities markets. And so there was so much trading, and they were dealing with paper certificates, which are pretty cool when you look at them, works of art. They're nice for the wall. But the trouble was that you had to process them, and there was not the data processing ability and capability at the time. So the New York Stock Exchange and other exchanges had to close down. at least one way. So the SEC was there and worked with the industry, and that's how DTCC came about, where securities were then digitized, and so they were globalized, the globalized securities, and immobilized that way, and then traded digitally. So that was a huge innovation. And other things through the years, the automatic trading systems, ETFs, all of those things SEC enabled through a creative use of rulemaking, of course, prompted by people, approaching the SEC and saying, what if, can we do it? And I remember my old boss, Richard Breeden, in the early 90s, the staff had been trying to think about ETFs. And when he said, well, because he had dumped the whole big file on my desk, say, figure out why this has taken, years to not even get out of the agency. And so the staff was saying, well, we're not sure if the market wants it. And so Richard had the best retort, well, how do you think you're going to find out? And that is like, let's try it and see what happens. So that things like that is what we're doing now with Project Crypto, and working with our counterparts at other financial regulatory agencies through the President's Working Group. So we're still meeting every week. We came out with a report a few weeks ago, which I encourage you all to read. It's relatively thick, but anyway, but it's, I think there are a lot of great ideas, and we're setting out at the SEC to implement them as soon as we can.
Yeah, it is a new day, right? And you guys have already made so much progress, Commissioner Peirce with the task force. And, one thing I think people don't understand is how OG you are, and that, back, he really is. And so like in 2015, I started in this in 2015, and I think you were in even before me. So he is very OG in the crypto space. And the traditional finance space too, which is so important to have both the TradFi, expertise and knowing the history and from you were a kid, going through computers and stuff, like first mover, always trying the first electronic products and everything this whole time. So I think it's, you can really see that in your leadership. And I don't know if everybody knows these things about, how, how tech forward you've been throughout your entire life and career.
Well, I still have an analog watch, but anyway, but that's okay. But no, there are, there's a lot to be done. There's a lot of spring cleaning to do at the SEC, not just with forging new roads, with this industry, but on the traditional side, there's a lot of, like I said, spring cleaning to do. When we look at, say, the IPO markets, I've said before, I want to make IPOs great again. There's so much negativity around going to the public markets right now because of a lot of things, just the cost of it, the complexity of the regulatory scheme and disclosure, the litigation issues around corporate governance, and the weaponization of some of that. So we need to clean up a lot of that and make it much more efficient. And so we'll be setting out to do that and bring people on to help us achieve that.
Yeah, and with the launch of Project Crypto, I think that's a really great initiative and moving forward and doing all of these things. And I think, I was very thrilled to be in the room when you announced it in that speech. And I think there was a standing ovation around the world about, bringing our markets on chain. And can you help everybody kind of understand a little bit more about Project Crypto? Because there's so many really important parts of it that you've discussed about, is bringing it on chain and making the US the crypto capital, and, reshoring crypto offerings, and how important just competition is, how important, choice for market participants, and even regulatory competition. So
yeah, there's a huge amount to do. And so the good thing is we have a president who has thrown down the gauntlet. I mean, he's not shrinking from this, and he understands the importance of it. He said it many times himself, even before he got into office here most recently. So, he wants to make America, the world running on American technology and make America, the crypto capital of the world. So that's a pretty, that's a pretty good goal, I think, and a challenging one. So we at the SEC in our little patch, it's an important patch of it, need to be forward thinking. And again, with this President's Working Group and David Sachs and Bo Hines, who are leading that, I think that's been in Treasury that has taken the pen to it. I think that's great. Has written down a whole, we've forged a whole bunch of to-dos from that. And so we'll be, attacking that, and already are. So as we go on, there are a lot of questions to be answered. And so I'm, salute the work of the folks in Congress who have, passed the Genius Act, which was great. Hallelujah. I mean, that really is a seminal step for the United States Congress and the government to now officially recognize at least one part. And so then there's a second bill that's come out of the House of Representatives called the Clarity Act, and you heard from Chairman Scott here earlier. He's a great guy. He has a really great committee that he's working with, the banking committee. And so I look for good things to come out of that. There's some things that we need to do in this whole thing, but part of it is to bring clarity to this industry. You've needed it so badly. You've paid enough in legal fees and whatnot, not just to fend off the government, but to try to figure out, what the crazy quilt of different opinions, court opinions and statutes and in the different jurisdictions, how do you kind of push forward in a legal business? And so that's one thing that we want to try to do. But what I really hope for is, I didn't come to Washington to engage in the turf battle. That's the last thing in the world I want to do. But we have to future-proof what is going on and what we're going to be doing, the rules of the road. Because 5-10 years from now, things will be completely different, I'm sure. And we can't put things into little, cement surrounded pockets that are immutable. So we have to have flexibility, I think. And so as far as the different areas, so securities, commodities, the banking area and whatnot, stable coins, the Genius Act, I think that took a really good stride there. And so for the rest of it, I've been talking about having a super app type of approach where why does one have to have a type of permission slip to go from being a broker dealer to dealing in commodities or whatnot. I think if we have, if you look at the banking industry, where you would never really design the regulatory scheme for 150 years, but it works. It's very flexible. You have, the banking system, and you have different pockets of it, the Fed, the controller of the currency, the FDIC, and all of that, and the states. So, but if one regulator becomes too obstinate or something like that, you can take your charter and go somewhere else who might be allowing you to do what you might want to do. Like, for example, famously, life insurance with banks. The control of the currency back, maybe 50, 40 years ago, allowed banks, national banks, to go into that, and then others followed suit. And I'm not talking about going down to the least common denominator. I'm talking about having a system where there is, we keep people honest by having kind of friendly competition, friendly, balance of power, and without having, I like to compare to, in the 1500s, the Pope divided the world between Spain and Portugal, the two big empires trying to struggle. over Terra Box back in the 80s. In the 90s, I'm thinking of single stock futures, portfolio margining. It wasn't that the two commissions didn't get along, at the board level, but it was even at the staff level where there was stiping and just prevarication there that didn't allow things to move forward. So anyway, all I'm pleading for is, flexibility so that we can keep the regulatory scheme adaptable to changes in the marketplace and technology as we go forward.
And I think that's a really important distinction too, and like the Shad Johnson Accord of making them work together to come up with something. And I think it's novel the way that you're thinking about it more as of an alternative, right? So they have the alternative types of frameworks. So there's one under different regulators, and there can be federal and state, and so there's optionality depending on your business, depending on how the regulators choose to do their regulations. So like some of the things I think people don't recognize is like all of the authority, exemptive authority, and how flexible the SEC is as an agency compared to the other agencies. You can trade on smaller systems. You have the Reg ATS, alternative trading systems, and you can exempt out and do so many flexible things with the SEC using the exemptive authority as long as it's not hamstrung, by any kind of legislation. So I think that's really novel and something that people, maybe aren't appreciating the ability to have alternative systems in a super app. I love like a horizontal super app where you can, trade your commodity securities and other things on one platform,
right.
There's
no reason why not. And so we have, right now people don't realize it, but securities exchanges could, if they wanted to, trade gold or, wheat for that matter, not the future side. That has to go to under this Commodity Exchange Act to futures exchange and there they have their regulatory. What we do with a statute. So again, to future-proof it from hanky-panky in the future, from somebody coming again. But anyway, but we have the flexibility to move forward, and we are moving forward to follow on with the path that we have set forth.
Yeah, and with that too, the work that you're doing with the administration and Congress, I think is also important, and people want to know about. Is it was in the the president's the working group paper that about continuing forward with what you're doing, and you've been working on a lot of kind of things that are really integral to market structure. Yes. And so to see kind of your approach, how the SEC is approaching market structure, which may be different than what we're seeing in the current drafts of the legislation. And one thing I wanted to focus on particularly, because there's a lot of chatter about it in the community, is this focus on decentralization in the legislation, and just kind of get some of your thoughts on that. Yeah,
that's a really good point. So decentralization, I think, is sort of a red herring, frankly. And it's nowhere in the statute, and it's not in Howie, it's not in, so anyway, it's kind of cropped up, and the SEC at the staff level made kind of a statement about that. So a number of years ago. We're not, I don't personally actually feel bound to that at all. We're going to be going in a different direction. And again, this is with the flexibility. I think we should have learned over the last decade or so that, that we cannot have things so abstruse that, lawyers can't give opinions to their clients, and that the clients then have to spend lots of time for legal analysis that may not go anywhere. So that's our goal, is to have good rules of the road that we put down, and hopefully, again, like I said, undergirded by statutory explicit statute. But in the meantime, through our own work with exemptive authority and other things, we will be able to provide that certainty. So, I as far as, the decentralization issue goes, again, I think that's the wrong analysis, with respect to the securities laws.
Yeah, and I think it's kind of interesting that such a focus on that. I'm not really sure, where it came from in, continuing to grow any kind of support, because even, people I think that came from a former director of corporation finance statement that, many securities lawyers and others have just kind of disavowed and not thought that was the right kind of way forward, overly focusing on one factor of a multi-factor test of one type of a security to then somehow take over the entire analysis of securities law.
Could be put on chain and make it much more efficient to process them and everything. So he did, and he had a company that was doing that. But so that wasn't a security. This on chain and all that, very centralized. That's not a security. And so I think the analysis has to be different. If you look at Howie itself, the orange itself was not a security. The orange tree was not a security, but the gestalt around it of, the organization and the promises made and all that, maybe, according to the Supreme Court, that was a security, but the individual components are not. And so we cannot go about looking at oranges, the tokens themselves, as necessarily being a security. I know there's a difference in the circuits, and we've seen with respect to some of at the district court level on the federal side, some of this analysis, maybe different ways. But from the SEC's perspective, we will plow forward and on this idea that just the token itself is not necessarily the security, and probably not. There are very few, in my mind, tokens that are securities, but it depends on what's the package around it and how that's being sold. But I can buy an orange, and I'm not necessarily buying the promise to have somebody harvest it, squeeze it, and then market it and then send me the dividend. So that's a lot different than I think just buying a token in the marketplace. So anyway, that's how we're going to be proceeding, and obviously there will be nuances and whatnot, but our goal is to set really firm and helpful guidelines that can be changed later. So let's not have it etched in stone through statute or whatnot, but we can be flexible as the technology develops. So I think it's a really exciting a time to be involved in all this, and look forward to comments and from you all and your colleagues. So.
And Congress and the administration are lucky to have an SME like you to go to. We're very fortunate, and so glad that you're leading this, and you're making it so that not only we have some clarity and forward-thinking innovation, but also being, I think how you said it is perfect is then when you are a security, it's not a scarlet letter.
It's not.
So.
Right.
right. I'll wait till everyone clears out for after Chair Atkins was here. Yeah.
Tough act to follow.
Tough act to follow. All right. Well, now that the room is half as full as it was 5 seconds ago, thank everyone who's sticking around. I think we've got a really great panel here. People have done a bunch of really interesting things across the industry around tokenization and payments. I'm going to let them introduce themselves because I would never do justice. So, John, maybe we'll start with you.
Thanks, Rob. John Nahas, Chief Business Officer at Alva Labs, supporting the Avalanche ecosystem. So growth across all sectors, different verticals, international jurisdictions. I've been with the firm almost 5 years now, so it's been an exciting ride seeing all the stuff Avalanche has been doing.
Yeah, Farouk Malik, co-founder and CEO of Rain. We're a stablecoin infrastructure company focused on payments, making stablecoins accessible and usable around the world for people everywhere.
I'm Daniel Coher. I'm Global Head of Digital Assets and Fund Distribution for Apex. For only 2 months prior to that, I was the co-founder of a company called Tokeny. We started 8 years ago at Venture in Luxembourg. We created a standard, the ERC-3643, that is now recognized as the official standard for creating representation of assets on chain. And that company was acquired 2 months ago by Apex.
Gabriel Ott, founder CEO of Denari. We are tokenizing the $100 trillion capital market and bringing it on chain and trying to reimagine what it looks like for stock exchanges to be global.
Yep. And I'm Rob Haddock, general partner at a fund called Dragonfly. So guys, I want to start with the topic of tokenization. Really high level to start with. Over that period of time, there's been kind of stops and starts of excitement about tokenization. However, while the growth has been pretty slow, and I think there's a lot of excitement in this room, there was a couple of announcements today, but it's still 26 billion of call it tokenized assets on chain. Half of that, or a little less than half of that, is Figure. So why is now different? Why is this time not just cynically a bunch of asset issuers trying to sell something to a new group of people? Gabe, I know you've been kind of outspoken about this, so maybe we'll start with you.
I think a lot of people are just trying to take advantage of the hype. I think many players are, as you and I, I think it's many years for this to play out in terms of token. Organization to come to fruition. I have no doubt, but there's now enough cash on chain to perhaps start to do something interesting and have it sort of grow there. But if we're expecting this to be kind of astronomical growth over a very short amount of time, I don't think that's going to happen.
Anything to add, Farouk?
Yeah, I mean, I think expanding on that a bit, right, I think we're in this phase where a lot of people are trying to figure out how do we make this like how it is or has been, which is close assets and tokenization behind a walled garden, where there's lots of different institutions that have had meaningful improvements in custody and delivery and pledging, et cetera. But they're using this technology infrastructure as, hey, what if we build a closed loop blockchain? What if we tokenize assets within our own ecosystem? I think the challenge that we're going to see over the next few years is that if you continue building or expanding this like walled garden framework, it's going to not really drive meaningful improvements, right? I think a lot of the utility of token is being able to pledge an asset that is custodied at one custodian to a lender that is outside of that kind of walled perimeter, and being able to utilize those funds to access utility across national borders or even across banks across the street from each other is going to have to be meaningful in order for there to be any meaningful change in the adoption of tokenized assets.
I would say that I don't think the industry's been ready on the technical front. I mean, the compliance has been changing, of course, for years, but for the most part, most tokenization you've seen over the course of the last several years has been that, right? Like certain people are saying, oh, we want to try this. We want to say we did this. We want to dip our toes in. But that world doesn't really work in the world that crypto infrastructure has been providing. I think you've had a black and white option of either public permissionless chains in which securities cannot trade compliantly, or you had those walled gardens of private permission enterprise chains, but that were missing the interoperability. And that's something that I'm really proud of that we're doing, and we're working with all of you guys and so many other players, is allowing that infrastructure to actually support the asset, to support the tokenization of the asset, the compliance requirements, the jurisdiction requirements, the many different requirements that are needed that up until now just hasn't been there, right? All these things have been a nice kind of announcement, a nice proof of concept, but for this to really flourish, it's going to take time, it's going to take growth, it's going to take interoperability, and all these things are now starting to happen.
So you said there was technical issues or constraints that are just now solved. Like, what are exactly those technical issues and constraints that are just now solved? What is the infrastructure and how has it changed recently that makes, call it us being able to be at the beginning of that J curve?
So I think, look, I like to talk about the fact that I think as an industry, we've had significant technological improvements, like by making blockchains faster and cheaper and more scalable and all this great stuff, but they don't solve business use cases, right? They're solutions in search of a problem. And we're still, for the most part, have been stuck in a first generation business model that doesn't work for real world adoption of real world assets and tokenization, which is the general purpose layer one thesis, right? Put everything on a single blockchain and it'll all just work. It doesn't work that way. The world doesn't work that way. Payment rails are different than securities, that are different than tokenization, than identity, than data, than whatever it may be. So I think you started to see this growth on the L2 side with Ethereum because people wanted that narrative and wanted to be connected to an ecosystem, but the interoperability really wasn't there. And now you're starting to see, other players, you're going to ask me about this probably, launching their own layer one blockchains. And we're proud that we're able to launch many different blockchains that are either jurisdiction specific or compliance specific or asset specific, but have the interoperability that's necessary to allow cash on chain to transact with equities and tokenized assets on chain. You can't have one without the other. We've had all this tokenization, but we didn't have the cash to trade it against and vice versa.
Daniel, you're kind of in a privileged position because you talk to all the issuers, right? And so you hear what these guys say as, infrastructure providers, service providers. What are you hearing from the issuers? Why are they excited at the moment? What has changed recently for them? And are you also hearing, hey, listen, we just want to reach a new audience, or there's some broader plan that exists?
Well, first of all, I think that you were mentioning some limitation from a technical perspective. The moment that you deal with a regulated instrument, that regulated instrument needs to be serviced by a third party, being an asset servicer or transfer agent. So part of the reason why we didn't see tokenization at scale is because those service providers didn't have the capability to implement tokenization within their own infrastructure. If you look at the top 10 fund services, for example, they work with 5 platforms: Paxos, FIS, eFront, etc. They simply didn't have the capability to tokenize. So the first thing that we need to do is to bring this capability within the fund servicer so that we can tokenize it at will, in a way. So what is interesting for asset managers and why I think it will accelerate is because we spent 8 years building this capability and implementing that capability within asset servicers. Apex, if you're not familiar with the company, that's a 13,000 people company. We service 30,000 funds for 14,000 customers. We spent the last 2 years implementing that capability within the back end, within the fund accounting system, to enable that tokenization at scale. So now, if an asset manager comes to Apex and asks for tokenization, we can implement that in just a couple of days. That's the game changer. Now, that brings the benefit of digitalization. That doesn't bring the benefit of decentralization. So most of the benefit in the short term are on the asset services side. They create operational efficiencies. But in order to deliver the benefit of decentralization, you need to do that at scale. So if you want to achieve secondary trading, expanding distribution, collateralization, you need to have enough market participants. You need to have enough assets represented on chain. So we now have this capability. So we now are in a position to deliver that value proposition to asset managers. That's why obviously we made this announcement today with Skybridge that we're tokenizing 2 of their funds for around 300 million. So now we bring in this capability behind the tokenization to allow the investors to access secondary and other third-party value-added services that will be appearing in the coming month because innovation is going at a speed of light. So this is something that we cannot project yet, what will be those services, but they are in the making.
Okay. Maybe on that vein a little bit, but Farouk, I'll jump to you. So there's a lot of different types of stablecoins. There's different standards. There's different types of money market funds, different standards, different legal structures. There's different, tokenized assets that are different standards, different legal structures, different technology stacks. Now we're talking about also like deposits, tokenized deposits. We're talking about, call it a bunch of other things that look like maybe stablecoin-ish, right? Are we worried about just like this like hodgepodge of things that kind of people put out there for their own incentives, but have no interoperability and just create this like huge amount of fragmentation that are essentially don't solve anyone's real problem, if that's the case? And how would you view that as somebody who kind of serves that broader ecosystem?
And look, I think that is not unique to the tokenized ecosystem or digital assets, right? Like you look at like gift cards, right? There's every merchant everywhere is issuing a gift card for a variety of things. And there's only a handful of people that are actually getting any meaningful deposits in that gift card ecosystem, right? And so just by having it doesn't necessarily mean that consumers want it or anybody wants it, right? And a big thing that we've been focusing on is that in the very early days of building Rain, we realized that there was all these competing stable coins, a bunch of different blockchains that had various value propositions. And it was a very diverse ecosystem, and it's continuing to get more and more diverse, right? I think that what we realized is that the way that the enabling technology can be whatever it is, but the way that people consume money or spend money or earn money, that's all for the most part the same. And it's the same everywhere in the world. Same with tokenized assets, right? So the way that you save, the way that you pledge collateral, the way that you borrow against online or on-chain assets is the same as how you do that with traditional assets. And the way that people interface with various different types of tokenized securities or tokenized assets or tokenized money is meaningfully similar to how you would do that normally, right? Tokenization is a mechanism to provide cost savings and automation by utilizing smart contract infrastructure and tokenized blockchains to drive significant improvements in efficiency. It's not necessarily just meant to be something that you do just for the sake of doing it. And so that's really been a big focus on how we think about this market. And I think that as more people start interfacing with it, they'll realize that, hey, this is actually the right way to start thinking about it, as opposed to thinking about it as a standalone asset class or a standalone technology or a standalone infrastructure. You have to think about this in the construct of how people operate their business, or how counterparties hold and spend or transfer assets, or how consumers hold, earn, store, save, spend, right? And so all of those types of things are unitary, whereas all the enabling technology is very diverse. And so in the short term, like we're seeing it now, right, where lots of different people are going to launch L1s or L2s or their own tokenization platform or their entire suite of asset services or whatever it is. And there's probably great business reasons to do that, right? The challenge with that is going to be that where's the adoption going to come from? Are those things going to be adopted by institutional adopters or consumer adopters? Will there be like staying power of anybody that's holding these assets? All of that is yet to be determined, right? What we found so far in this market is that for the major players in tokenized, like real world assets, for example, all the money lives off chain, right? So it's just a mechanism by representing some sort of instrument on chain, but all the cash is going into institutional custodians, it's going into T-bills, and all of that is being held outside of that ecosystem in the hands of traditional players for the most part. And there's great players like Apex that are coming in, driving some innovation there. But for the most part, the market participants are holding the money in the way that they always hold money. And we've seen this story play out, right? Like in the last kind of bear market, a number of real world assets were plagued with no repayments or rehypothecation problems, and the money was stuck or gone and people didn't pay back. And you can't solve this problem by moving the industry forward, but then leaving it as a sole dependency on the existing way of interfacing with money.
Maybe Gabe, on that point, so you just launched or announced that you're launching your own L1 on Avalanche, trying to become the DTCC of crypto or tokenized equities. Some would say that you don't necessarily need a clearinghouse in and of itself in its own blockchain. and because blockchains already can do that, right? Tell me like why that's not true, right? And why it makes sense for, call it your own, for your standard L1 versus somebody else's standard versus somebody else's standard.
Yeah. So our L1 is a special purpose L1 that is not aiming to aggregate all of the liquidity onto our chain. Rather, what we found is, whether it's Base or Arbitrum or Solana or whatever chain is, they're competing for liquidity, right? And so they want, tokenized NMS securities on their chain, let's say, right? It's the biggest asset class. So they want whatever tokenized version of that to be on there. Well, what we found is we want to work with all these partners to fulfill, whatever their desire is. However, we don't want to your point, fragment liquidity. And that's exactly what happens if you just mint to Solana and it just trades among Solana. You've fragmented liquidity, from between there and Arbitrum and Base and all the stuff. So we built our specific purpose L1 to be an order book that matches orders across chain. So now an order can come for Apple shares on Solana that will get matched with a sell order on Arbitrum or Base or whatever. And the technology was built so that it will sort of seamlessly do the trading while keeping a master ledger of all the assets across all the different chains.
Can't you just run your own solver or run this off chain? Why do you need your own blockchain for this?
So we have run this for the last couple of years off chain. The reason for doing it on chain is twofold. One is like kind of DTCC and the way it is today, we do want this order book to be member owned. And so we don't want it to be on Denari servers, basically. And so we already have partners, consortium members that are coming in that are helping us with the governance of this order book. And the second part really is I feel like transparency is kind of overused, but I think there was a need for us to balance sort of auditability with privacy, which is something that we could do on chain a little bit easier actually than doing it on our own servers. So it was a couple of those reasons why we decided to actually like on-chain this thing. And just to be clear, like we're now allowed to do this only because FINRA and SEC have allowed us to do this. So part of why now is also we've just been waiting for the regulatory framework to sort of come into existence to allow for this in the first place.
Yeah, so we've seen all of you have alluded to these like other blockchains that people are launching. There's obviously the Robinhood L2. There's, but now there's the Strike L1. You probably have a perspective.
I think it's absolutely sustainable. I think it's what's going to happen in the future. I think what's going to collapse is a lot of what currently exists out there. All the general purpose L1s that remind me of the early days of the internet, like AOL. Let's just put everything on one single
site. AOL.
One single, yeah.
Okay.
A very fast singular AOL, correct. I don't see a world in which all of the trading, all of the digitized assets and identity and government use cases and applications all trade on a single blockchain. That's not the way the world works. AOL had its moment. AOL had a tremendous trajectory. Kudos to our competitors, but there's a ceiling there, right? AOL hit a ceiling, and then WordPress came and just opened it up to everybody. And I think that's where we are. I think you've seen all these L2s first launch, because to me that's kind of like the IBM analogy, right? No one ever got in trouble for hiring IBM, right? But it wasn't always the best choice. And Ethereum is safe, and Ethereum has been around for a long time. And there was a narrative and an association with Ethereum that was very beneficial. I think that's great, but L2s don't finalize instantly. You need to wait 3 days, 4 days, whatever, however long, however many hours for those transactions to finalize. Finance doesn't work that way. I mean, it does work that way. That's how the incumbent systems. And what are we doing by putting it on chain if it's exactly the same thing? So to your point, I think we're starting to see this shift with purpose-built L1s. Gabe is leading there on that example. But we've seen this on our side with Balcony that's bringing $270 billion of deeds in New Jersey. on chain, on their own chain, right? Because that's not going to trade alongside meme coins and NFTs and JPEGs. You're seeing FIFA, a global sports enterprise, wanting to launch their own chain in which they're going to have a whole lot of use cases across payments and tokenization and collectibles there. So you're seeing it now with Stripe, and you're seeing it with Circle, right? These guys are crypto native though. They have the understanding, they have the knowledge, and they have the first mover advantage to say, we're just going to build our own layer one. But they're not building a general purpose layer one. They're building a purpose built layer one for their use case, for their business. And you're seeing this with jurisdictions. We launched the chain in Saudi Arabia under the monetary authority there, with banks that are based in the kingdom, with nodes based in the kingdom, because that's what was necessitated for their compliance requirements. Now imagine how many more banks and how many more enterprises, and how many more asset managers, and how many more issuers are all going to eventually want their own blockchain. There's not enough engineers, there's not enough resources to do that. So you'll be able to spin up your own blockchain, whether private permissioned or permission public or public permissionless, and have that interoperability. I know we provide that. We have fantastic partners that allow for that. That's where I think this industry is going, and that's where I think it should go. That's our bet.
Okay, so you heard it here. Avalanche is WordPress, and Solana is AOL. So we're going to quote that one.
AOL won before WordPress did.
Yeah, okay. Daniel, so from your seat, obviously it's kind of core infrastructure for a lot of these people, these asset issuers. You talk to so many people across the industry. Like, how would you respond to that, right? Like, what is your perspective on that? And what do you think your clients' perspectives on that will be?
Well, if you look at every single financial institution as being its own network today, well, we can only do better, right? So if there are still 20, 30, or a couple of hundred chain, you're still going to deliver operational efficiencies by having the data represented on a chain that is natively interoperable with the second one, and everyone sharing the information transparently, removing the need for a lot of third party. We mentioned, BTCC, CSD. Obviously, I spent 10 years at a CSD, so that's the reason why the first place I invested in Tokeny is because I know that this business is doomed. Now, not everything, obviously, that they're doing will disappear. There is one thing to manage counterparty risk. There's another one to manage systemic risk. What happens if a company is going bankrupt overnight? That's what a CSD does. So those are still things that need to be addressed. But yes, I think that there is definitely a future where there be a number of blockchain, and there will be solutions that provide interoperability, being layer zero, being Chainlink, wormholes, and others that will ensure that from a technology perspective, you don't have to worry about it because it will be managed by someone else. And probably in a couple of years, we will not talk about tokenization. That's my biggest hope, because tokenization is nothing that representing the asset on an infrastructure that has more capability. Do we talk about Excelization? No. So why are we talking about tokenization? We'll focus on user experience, value creation, and the technology as much as we've seen that with internet. Nobody knows how TCP IP works, nobody cares. In the mobile phone, you had to put your GPRS access point in the beginning, otherwise you couldn't roam. All this will disappear.
So, real quick, he did mention something I want to touch on, because you did kind of create a quote for me that I didn't really say. He said, in the future, we're not going to talk about tokenization. Everything will just be tokenized. And in the same vein, in the future, you won't talk about on what blockchain is it on, right? It's not on Avalanche. It's not on Solana. It's not on Ethereum. Where is it? Who cares, right? It'll be on whatever chain somebody decides to launch for that use case, right? So there could be in the future, and there should be in the future, 1,000 Ethereums alongside 1,000 Solanas, alongside 1,000 Move-based virtual machine chains. And in 3 to 5 years from now, it's silly to think that there won't be a better virtual machine than the EVM or the Move VM or the SVM or whatever the VM of the moment is. There'll be breakthroughs that continue to grow, and those breakthroughs will be adopted on new purpose-built blockchains that will have interoperability with legacy-built blockchains, and the wheel will continually grow rather than just kind of spin in place, which it's been doing.
Maybe one interesting figure, when we started 6 years ago, core that was like the private chain of everybody. Last count, there was around 600,000 people who can code in Solidity. And there's not even a school that teach how to code in Solidity. So that number increased day by day. So in a year from now, there will be 1 million people. So think about what it means in terms of reducing costs, creating efficiencies, and unlocking innovation.
Yep. Okay. So a few minutes left. I have 2 questions I want to do, like kind of rapid fire, get everybody's responses to. First one is, tokenization fails, things don't get tokenized. what happened, what went wrong, or how did the world evolve? Gabe, maybe we'll start with you.
I think the failure would be on the regulation and the compliance part here. I mean, throughout history, the better technology wasn't always chosen for one reason or another. Our financial system is largely today built on technology that was built in the 80s. So these things take time. And so I think that's the main thing that would get in the way. That said, I'm seeing really positive changes on that, right? We're the first broker-dealer to be able to tokenize NMS securities that FINRA approved, right? So there is movement here and a willingness to participate. So I'm very bullish that everything's going to get tokenized, but if something's going to stop it, it's because somebody, the powers that be would say, no, we're not going to shift over to this better technology.
Well, I sold the company 2 months ago. I don't care anymore.
The most honest answer on this panel. Love it.
Well, I think coming back to the point we said, well, it's not about tokenization. There's a better technology out there, and this infrastructure to transfer information. Blockchain is the infrastructure to transfer value. That's what it is. Bitcoin shows us the way. That was an application, but Bitcoin is as close to tokenization that TikTok is close to emails, right? Sitting on the same infrastructure. So this is just going to be part of our everyday life without even noticing, as much as we're exchanging emails today, and we thought it would never happen. And you see the adoption curve is exactly the same. We reached 800 million users after 20 years of existence of the blockchain. Same thing for the internet. And then you have those applications that basically demonstrate the value, and then you have those tipping points suddenly happening. I think that we will see those applications coming in a couple of months, and we'll see the tipping point, and we'll not talk about tokenization anymore.
Yeah, I mean, echoing, what Gabe said earlier is, I think regulation has the potential to really muck things up. And I mean, look, if you look at the internet, right, there's a lot of countries that got left behind on the internet, because even today, if you go there, you try to connect to Wi-Fi, you have to put in a national ID number, right? They want everybody that connects to the internet to tell you who they are. And a big part of America was that information is free. And that's been a big ethos in this country. And it's a big thing that lets us kind of innovate freely, or has historically let us innovate freely. And I think that right now, technology, I mean, whether it's AI, whether it's blockchain, whatever it is, it's like regulators seem to think that anybody that wants to push an industry forward or create a new paradigm is inherently bad. And I think that has changed a bit. I think that there's tremendous amount of work still to be done, but I think that really has the potential to mess things up.
If it is to fail, which it won't, but if it is, I would blame it on this industry, spiting its face to save its nose, arguing about the minutia that on the day-to-day basis, and not really providing solutions to fix people's problems and doing things that actually change people's lives for the better.
Last question. I want like two sentence answers. So start with you, John. Your most controversial take about where we are 5 years from now?
Come back to me, Gabe.
Well, just go down the line.
Okay, Farouk.
Well, I'm gonna be consistent. I'll be on the beach.
Look, I think for us, I mean, the way that I think about this and that we think about this at Rain is that it's just money, right? It's just the next iteration of how you can program things and make it more efficient, make it more accessible. And so right now we talk about the enabling technology, but it's just money.
That's not controversial at all.
Controversial take in 5 years from now, no one's going to care about blockchains like they do today.
I think
I'm still on the beach.
Crypto and finance are going to become synonymous. I think 5 years is a little bullish, but you said be shocking. I actually don't think there's going to be a difference.
Okay. I'm a VC. I have to be optimist. So. Okay. Well, thank you, everyone. Thanks for the panelists, and appreciate the time.
I'm John Darcy again, the CEO of SALT. I just wanted to provide an introduction to our next speaker who, when we set out to create this conference and do it in August in Jackson Hole, like I talked about in my opening remarks, one of my big goals was to engage with the Federal Reserve, which hosts their annual economic symposium next week up at Jackson Lake Lodge. And I'm really grateful to have Vice Chair for Supervision, Mickey Bowman, joining us on stage here in a moment. The speech is also going to be live streamed. So please join me in welcoming Vice Chair for Supervision, Mickey Bowman, on stage. Thank you.
I'd like to just thank you for the invitation to being here with you today. It's really a pleasure. And good afternoon, everyone. Thanks. I first want to thank the organizers of the Wyoming Blockchain Symposium for inviting me to speak to you today. It's really an honor to be included in this year's event, which is being held at a critical moment for American leadership in the digital asset space. We're at the beginning of what appears to be a seismic shift in the way we think about money, value, and the fabric of our financial system. This shift is not just about incremental changes or tweaks to the existing system. What we're witnessing has the potential to fundamentally transform the way we live, the way we work, and the way we interact in society. It's inspiring to be together with all of you as thought leaders who are engaged in developing technologies that could help shape the financial system well into the future. You don't need a tech background to appreciate the opportunity that blockchain provides to the financial system. Financial services innovation drives faster, safer, cheaper, and more customized products that more efficiently meet the needs of consumers and businesses. Digital processes like wire transfers and ACH disrupted the need to move large amounts of physical currency and other hard assets, making the system more efficient and safer. Through technology, there is opportunity to transform how we think about transferring assets. Throughout recent history, whether previous transformations involved industrialization, communications, or the internet, each of these advances had a profound and lasting impact on our society. While the future is unknown and unknowable, I expect that we may look back at some point to consider the impact of blockchain, of AI, and quantum computing, and marvel at the transformation in everyday business processes. Time will tell, but the opportunities and possibilities that lie ahead may be profound. Of course, you know better than most that bank regulators approach technology and periods of change with caution and skepticism, concerned about rapid growth, new business models, greater interconnectedness and interdependence, and we often focus only on the risks. But risks may be offset, or at least determined to be manageable, when we recognize and consider the potentially extensive benefits of new technology. Today, I'd like to address the Federal Reserve's approach to thinking about technology and tools like blockchain in the context of supervision, including recent developments in the cost of supervisory focus on reputational risk and principles for a tailored and permissive regulatory framework. One, technology. Let's start by talking about system through regulation and supervisory practices. Our goal is not just a safe and sound banking system, but one that also serves its intended purpose of supporting consumers, businesses, and communities, and fostering economic growth. To accomplish this goal, Regulators strive to strike a balance between managing risks that threaten safety and soundness, while also creating an environment that allows new technologies to take root and grow. Innovation outside the banking system often complements the development and use of technology within the banking system, and it often far outpaces that growth. As you all are well aware, many groundbreaking tech innovations have been pioneered by developers outside of the traditional banking system. But we are seeing a number of promising developments inside the banking and financial system, and I'll start with tokenization. While progress on tokenization is moving ahead, it's helpful to identify and understand the problem that it's intended to solve. One clear friction is in the transfer of asset ownership, which includes both completing the asset transfer, which may involve re-registering securities, or transferring physical assets and coordinating the timing of the purchase and sale. Asset transfer frameworks are designed to minimize the risk of transaction failures, and they have historically relied on escrow agents and manual processes. Tokenization has the potential to facilitate faster ownership transfers, mitigating some of these well-known risks and potentially lowering costs in the process. But tokenized assets enable a transferor to pass title without changing a custodian or moving any physical security or asset. Many banks and international organizations have begun projects to develop this technology, but we have not yet seen broad adoption. It's possible that we could see a tipping point where the processes themselves are well established and legal frameworks have been updated to permit a wider range of activities relying on that new technology, and tokenized asset transfers become more of a market standard. There are other potential advantages to tokenization, including expanding access to capital markets and facilitating near real-time payments. The speed and cost of wholesale payments, especially internationally, is a long-standing problem that tokenization could help to address. Banks of all sizes, including community banks, can benefit from efficiency gains that flow from asset tokenization. New technology and processes can open the door to direct, faster, and lower cost payments. While tokenization may be a part of the solution to a number of known frictions in the banking system, the blockchain technology that it relies upon has already changed how banks seek to engage with their customers. For example, while digital assets have been considered to be risky, many banks are improving their tech stacks and security infrastructure to provide digital asset custody services to a wider range of retail customers. Very few bankers and even fewer regulators anticipated that the market would accommodate this development even just a few short years ago. Yet we've seen much progress and a growing appetite for traditional bank engagement in this space. We're also seeing positive signs in the evolution of the digital asset user experience, making it more accessible and easier to use. One recent development, Congress passing the Genius Act and the president signing it into law, has brought stablecoins to the forefront of many discussions. And they're now positioned to become a fixture in the financial system, with implications and opportunities for the traditional banking system, including the potential to disrupt traditional payment rails. Congress has tasked the banking agencies with creating a regulatory framework for stablecoins, and we're working with our colleagues in the other agencies to move this forward. It's essential that banks and regulators are open to engaging in new technologies and departing from the overly cautious mindset. Regulators must understand new products and services and recognize the utility and necessity of embracing technology in the traditional financial sector. So how do we accomplish this? Some of you may have had direct experience with regulators in the banking system as you attempted to engage in this type of partnership with banks through the introduction of new technology and services. I'm sure that many of you were not satisfied with those interactions. When you start, is that an understatement? When you start from a world of possibility, where you move fast and you break things to make rapid improvements, you may struggle with that complex and rigid regulatory construct that's familiar to bankers and regulators. In this world, inertia can easily set in and pose resistance to anything not deemed within the realm of traditional banking services and activities. But despite this past inertia, change is coming. Bank regulators are taking important steps to create a framework for digital assets and the adoption of blockchain technology within the banking system. These steps will promote accessibility to banking products and services by removing supervisory impediments that have stood in the way of relationships. To encourage industry to engage with regulators to help us understand blockchain and its potential to solve other problems. What's the value proposition of any new product or approach? What problem is it intended to address? And how should regulators consider both the risks and the benefits so that we can provide a path to allow its use within the banking system? We've already seen some initial benefits of bank AI adoption, and I continue to be encouraged by these significant ongoing investments being made in AI and in machine learning. These technologies have the potential to transform how business is conducted, including the way we prevent and detect fraud, manage risk, and provide customer service. During a recent banking conference at the Fed, Sam Altman, the CEO of OpenAI, joined me for a fireside chat on AI in the banking and financial sector. One highlight from our discussion was the two-sided nature of how technology can impact banking transactions. Just as AI can undermine customer verification methods designed to identify and mitigate fraud, AI tools can be leveraged to detect and mitigate fraud. And I see similar challenge with blockchain technologies. Some bankers have expressed concerns about new technologies posing a threat to traditional business models and practices. But the banking system is constantly evolving, and technology can change the banking system regardless of how banks and regulators choose to respond. We must choose whether to embrace change and help shape a framework that will be reliable and durable, ensuring the safety and soundness and incorporating the benefits of both efficiency and speed. Or we can choose to stand still and allow new technology to bypass the traditional banking system altogether. The choice from a regulator's perspective is clear. I am open to these discussions, and I look forward to learning more. Many of you at this conference today have a great deal to share and have new ideas about the best regulatory approaches to blockchain and digital assets. So let me start with a specific request on fraud. How can new technologies be leveraged to fight fraud? It's a major challenge in the financial services sector, and if blockchain or other new tools can help to mitigate it, we should explore those use cases. If fraud can be addressed using new technology, we should make sure that the regulatory framework does not stand in the way. I see this as an exciting opportunity for collaboration between industry and the Fed. The promise of technology and advances like AI are already positioned to impact parts of the banking and financial system. And ideally, changes will occur with the willing embrace of regulators, allowing use cases to proliferate in a way that benefits the banking system. If this is not our approach, then we risk the banking system becoming less relevant to consumers, businesses, and the overall economy. As a result, the banks will play a diminished role in the financial system more broadly. And those who follow developments in bank regulation have hopefully recognized a number of positive steps that demonstrate our commitment to embrace change. I am committed to changing our culture at the Federal Reserve and our attitude toward the adoption and integration of technology and new products and services. So I want to turn now to talk about debanking and reputational risk. In late June, the board announced that reputational risk would no longer be considered in our supervisory processes. To implement this lasting change, we are updating our guidance, our examination manuals, our handbooks, and other supervisory materials to ensure the durability of this approach, which is a critical. I'm also considering whether we need a regulatory change to provide greater transparency and certainty about this approach. It's not the role of examiners or policymakers to direct which customers or industries to serve or which products to offer. That decision lies solely within the purview of bank management, limited only by the safety and soundness of the institution, the legal activities of its customer, and risks, if any, to financial stability. Over time, reputational risk emerged as a priority area that policymakers emphasized for examinations. Exams or reviews focused on reputational risk have often lacked a sufficient nexus to financial risk and safety and soundness considerations that are the appropriate focus for our supervisory activities. So let me be clear. We must adopt an approach that does not penalize or prohibit a bank from banking a customer that's engaged in legal activity. This approach must allow and encourage banks to provide banking products and services to any legal business without disfavoring any particular viewpoints, businesses, or industries. So I'm going to turn now to talk about the approach that I've adopted since becoming a regulator, which is the importance of outreach. The industry, whether it's traditional finance, community banking, or digital assets, should expect a constructive engagement with our supervisors when they're discussing strategies or approaches for innovation. As regulators, we must engage in a way that enables our supervisory teams to understand the technology or innovation that's under consideration, and have an open-minded view about the benefits and the possibilities of a new approach, while also understanding effective mitigation strategies that could address any risks. Banks should be encouraged to explore new technology, to engage in discussions with their regulators about how they can be deployed, and what reasonable supervisory expectations should apply. In this context, a healthy dialogue and a commitment to learning ensures the bank and examiner relationship can be collaborative rather than agnostic in tone or antagonistic in tone. Innovators, banks, and regulators must develop a constructive relationship, and this relies on a commitment to ongoing outreach. As I've demonstrated throughout my tenure as a regulator at both the state and the federal levels, I'm committed to outreach that enhances my understanding of industry preferences, challenges, and better ways to engage with both developers and adopters. We should build an examination workforce that requires skills development and informed judgment to address evolving business preferences, practices, and expectations. And in a step toward doing so, last week I announced that the Novel Banking Activities Supervision Group would be reintegrated within us. Our approach should consider allowing Federal Reserve staff to hold de minimis amounts of crypto and other types of digital assets so that they can achieve a working understanding of the underlying functionality. While there are many resources available to learn about these financial products, and we will still soon be establishing a framework for supervising issuers of these assets, there's really no replacement for experimenting and understanding how ownership and the transfer process flows. I certainly wouldn't trust anyone to teach me to ski if they've never put on skis, regardless of how many books or articles they've read or even wrote about it. So we should consider whether limits on staff investment activities may be a barrier to recruiting and retaining staff with necessary expertise and for existing staff to better understand the technology. Going forward, it will be necessary to continue to implement a tailored approach to these new technologies in our supervisory activities. An approach that balances the supervisory and regulatory expectations in a way that is commensurate with the risk. What would this look like in practice? It needs to include regulatory certainty, tailoring, consumer protection, and maintaining America's reputation for providing an open environment for innovation. Regulators should abide by these principles in developing this framework. The first principle is essential, and that's regulatory certainty. Justifying investing in new blockchain development specifically for the banking industry, or even repurposing existing blockchain technologies for this sector, requires significant investment. Why would you make that investment without a clear understanding about how regulators will evaluate new use cases in the highly regulated industry of banking? Would you choose to partner with banks knowing that this will bring regulatory scrutiny and uncertainty, or would you develop alternatives outside of the banking system? Your industry has already experienced significant frictions with bank regulators, applying unclear standards, conflicting guidance, and inconsistent regulatory interpretations. We need a clear, strategic regulatory framework that will facilitate the adoption of new technology, recognizing that in some cases, it may be inadequate or inappropriate to apply existing regulatory guidance to address emerging tech. Having clear and transparent rules is not effective if the rules are unnecessarily burdensome and restrictive. So my second principle is that rules must be well calibrated and tailored to address the risks. Well-calibrated regulation promotes responsible innovation while also aligning incentives for long-term growth and stability. Tailoring rules and supervision requires regulators to approach each use case based on particular facts and circumstances, rather than applying expectations designed for an imaginary worst-case scenario that differs from the actual use case. We can't adopt a one-size-fits-all approach. And regulators must recognize the unique features of these new assets and distinguish them from traditional financial instruments or banking products. A third principle is that frameworks must be consistent with generally applicable rules and requirements. Customer-facing products must comply with consumer protection laws, including those prohibiting unfair, deceptive, or abusive acts and practices. We must think carefully about appropriate regulations to protect consumers and investors, maintain bank safety and soundness, and preserve the stability of the financial system. Any legal framework must also include appropriate Bank Secrecy Act and anti-money laundering requirements to fulfill the important policy objectives of these requirements. Finally, we need to build a framework that allows the US to continue to be the best place in the world to innovate. Failing to do so could jeopardize American competitiveness in the long run. Regulators have taken preliminary steps to support blockchain technology within the banking system, as well as to eliminate deterrence for banks to provide services to the digital asset industry. And I'm confident that with the benefit of ongoing outreach and education, we will build a framework that is fair, efficient, and transparent. So in closing, I just want to note that we stand at a crossroads. We can either seize the opportunity to shape the future, or we can risk being left behind. By embracing innovation with a principled approach, we can define the course of history and fulfill our responsibility to promote the safety and soundness of the banking system and financial stability. We are mindful of the potential risks and vulnerabilities that result from rapid transformation. We're cautious about the unintended consequences, and our mindset and policies guide us toward minimizing risks. But we must pay equal attention to the benefits side of the equation. Innovation and regulation don't need to be on opposite sides of the spectrum. In fact, they can complement each other. A more modern, efficient, and effective financial system furthers key regulatory objectives, promoting safe and sound banking operations, financial stability, and economic growth. Thank you very much. Thank you.
Thank you, everybody, for joining the morning content on day one of the Wyoming Blockchain Symposium. I told Governor Bowman social media is already a buzz about her comments. So lunch is served both on the Cottonwood Terrace and lawn, as well as in the Stead Fire Chop House within the Four Seasons. So you can go get lunch there. Thank you all.
Tesla's stock is crashing. The headlines say Elon's empire is collapsing. But what if they're all...
Welcome back to Squawk Box. The crypto firm Gemini, backed by the Winklevoss twins, considering an IPO as soon as this year. That's according to Bloomberg. And they're saying that the crypto exchange is now in talks with potential advisors on a listing. The report says no final decisions have been made, but we talk about, I don't know if they're going to have the last laugh, but, you know, when you start to think about the history of the Winklevoss twins and the economics of Facebook and the movie and hanging out with Larry Summers.
They've had a very tumultuous and high-flying
and successful run.
And, yeah.
I mean, that's the thing. What a journey.
And
What
they
a
were
journey.
probably Bitcoin bulls when it was under $1,000. They think it was like $12.
Remember, we used to have them on the broadcast, I would say back in 2011 and 12.
I mean,
Not that long ago?
Yeah, you got to hand it to them.
So they were super early.
You got to hand it to them. And if you are super early, I don't even want to venture. Yeah, I don't even want to venture a guess. At least they're not tall, handsome, and athletic.
Oh, wait.
Huh? They're only like when they do the movie. I mean, it's not going to be Army Hammer.
I think Larry Ellison has even said he felt a little bad about how
Summers.
Larry Summers said he felt a little bad about that scene in the movie when they came in and he kind of balled them out. He said he felt a little bad.
I wonder if that was but to totally shift gears and go right into crypto from there and all in. And from the very beginning, they said people that would argue or, you know, pick your bear, your crypto bear. That's it. Don't argue with it's mathematics. Don't argue with me. It's mathematics.
What was their idea about something that was happening in space that
I
was
don't
going to
remember
impact
that, yeah.
Bitcoin?
Oh yeah,
it's some wild idea. I mean, if you go back, I got to go back now and look. There was some. I mean, there were a couple of sort of very wild ideas about the rationale.
So tell me
of what was going on.
What you can either do what a Winklevoss is worth or what the Winklevi are worth. You got a number? You got a number? To begin with a B? Definitely, right?
I just haven't followed it closely enough.
I guarantee. I think they're.
I mean, assuming they
well
held on to it. Yeah, we'll have to keep looking for it. Anyway, separately, Meta's CEO Mark Zuckerberg visited the White House yesterday. The company said that he was there to discuss the company's role in helping the Trump administration with America's international tech leadership. It's unclear whether
Welcome back to Squawk Box. Cryptocurrency exchange Gemini's space station filing for its IPO and joining a wave of digital asset firms seeking to tap into the public markets. The company, founded back in 2014 by billionaire twins Cameron and Tyler Winklevoss, it plans to list on the NASDAQ right here under the ticker symbol GEMI. Terms of that offering were not disclosed in a filing that was made public on Friday. The company supports more than 70 cryptocurrencies and operations in more than 60 countries. It also supports stablecoins and issues the Gemini dollar stablecoin. Now, in the 6 months ended June 30th, Gemini reported a net loss of about $280 million on total revenue of about $69 million. That compares with a net loss of $41 million on revenue of $74 million a year ago.
Those guys.
Are you jealous?
Yeah.
Jealous.
I mean, they get screwed out of Facebook, and it's like that doesn't even.
The next thing will come along.
And they're still 6'5", and they look like that. And now they're both billionaires.
They were billionaires long before this.
Yes.
I know. Well, that's even. You think that helps? I think that makes me feel.
Monday.com's AI blocks are a total game changer.
Excuse me if I find that hard to believe.
You know that llamas are biological.
All right, let's move on to some IPO news. So Bullish, the cryptocurrency exchange, just IPO'd. They raised $1.1 billion in the IPO. The stock opened at $90 on the New York Stock Exchange under the ticker BLSH. The IPO was oversubscribed. It was $37 per share, and it's currently trading at around 70. So it reached as high as 90, crashed back down to 70. Let's talk about this for a minute. So first of all, like, what is Bullish, right? It's a cryptocurrency exchange. They pitch themselves as a highly regulated exchange with deep liquidity for institutions. So they pitch themselves as the exchange that institutions can get a better deal at. The CEO, Tom Farley, he's the former president of the New York Stock Exchange, so that reinforces the exchange's Wall Street credibility and institutional positioning. Interestingly, I didn't know this, Bullish acquired CoinDesk in 2023. That's interesting.
Oh, yeah.
What I wanted to say about this IPO, what does this IPO mean? Well, I think it means, to me, it's like it's kind of a top signal or just like a sign of how frothy everything has become in the TradFi markets as it relates to crypto. So this IPO, it's valued at actually a much higher revenue multiple than Coinbase. So Bullish makes around 3% of the revenue that Coinbase does. So like, yeah, Coinbase makes like 25x the money that or more that Bullish does. And actually, Bullish is currently unprofitable. So they have a net loss. It was reported around 349 million in Q1 2025. If you look at the valuation of the company at its peak, just like a day after launching, it was worth $13.2 billion. By comparison, Coinbase, the Coins stock, is valued at around $80 billion. Coinbase has a revenue of around $6.5 billion. For Bullish, that would be a revenue to valuation ratio of around 86 at the peak. And for Coin, it's like 10 to 13. So extremely frothy, in my opinion.
Yeah, way overvalued. And when I saw these numbers, the first thing I thought of was the pump.fun ICO. Honestly, that's just what I was like, oh, looks exactly like the pump.fun ICO, right? Like people got in at a lower rate and they're incentivized to sell as soon as it launches, because why not just instantly double, triple your money? And then I can imagine this will just trade downward from here, right? Like, because everyone who got in at the roadshow thing or whatever it's called, they're still going to be in crazy profit, I'd imagine. And so I agree 100% on this.
I don't think it's a buy. I mean, some other factors at play here, right? I guess there's pent up IPO demand. We haven't seen many IPOs over the last like 4 years. That's one factor. Obviously, the whole crypto meta is kind of like hot in the TradFi realm. So people are like, okay, this is a crypto company, buy. And then maybe the third piece for why this popped so much is there are no AI companies IPOing. That's what people really want exposure to. But this is kind of like a second best, I guess. Somehow AI and crypto are connected in the minds of TradFi bros, maybe.
Yeah, I mean, I think the first thing is the biggest, right? Like that crypto is hot right now because of the digital asset treasury meta, right? And you've seen just these insane multiples on that, meme coin multiples, you know? And that's like catnip for people in TradFi. Like, oh my God, you can get 10x in a short amount of time.
Yeah.
As you said, IPOs there hasn't been like an IPO season in TradFi since last cycle. And so that probably has kind of a feel similar to ICOs in crypto would be my analogy. And yeah, it just seems crazy. But let me ask you a question, Graham. How much do you think this is going to resemble so many of the charts in crypto where you have this initial pump and then just a sell-off forever, you know?
I think it's going to be exactly that. And it might bounce back someday if Bullish actually does a good job. But I actually think that would be years from now, if ever.
Yeah, I agree.
Kind of like the .com bubble, like where some of these companies did come back.
Yeah, exactly. And they have CoinDesk, so they have consensus, and it's a decent way to kind of maybe get exposure. I don't know, but here's the problem with all this though, which I think we've talked about before though. You go to a conference, if you're a conference goer, you're pretty much as close, you're going to be crypto native or as close enough to it. You're going to be on like 10 exchanges already, right? Like you're going to have tons of exchanges. That's not where you're going to get new users, I'd imagine, at a conference. You want to advertise to my mom or something like that.
Well, they position themselves as the institutional exchange. So, maybe by hosting these conferences, they get access to whales.
But are they?
Whales, new entrants. Yeah.
Not in the US. I mean, why would you do that versus Coinbase or Gemini, for example? Gemini gets a lot of institutional flow, I think, too.
Yeah.
So
well, speaking of Gemini and the IPO window, the Gemini and Kraken and others are sort of scrambling to get in.
That's right.
While the getting's good.
Yeah. So August 15th of last week, Gemini filed a registration statement with the SEC.
This is how to get in shape fast.
If you want to drop this, start eating more of these. You might.
For an IPO on NASDAQ under the ticker, get this, GEMI. Again, this is long overdue. I remember last cycle, there were rumors that they, late in the cycle, they were thinking about IPOing then, but they decided to hold off because they saw that, I think that they saw the markets were getting a little frothy. And so they held on to now. So the Winklevi, they're the ones who founded Gemini. It's one of the oldest, most respected exchanges in crypto, certainly in America. And like I said, they have kind of catered, I think, to kind of hardcore crypto users. And I think they have a fair amount of institutional flow. You know what? I'd imagine that this goes higher than bullish. They raised 1.1 billion. You'd have to think that Gemini is easily able to outdo that. At least I would.
Just a note here, which is that Gemini is also somehow a crypto exchange that is not profitable.
Oh, really?
I'm not sure how that works. Yeah. So according to its latest S1 filing, which was covering the months ending June 30th, Gemini disclosed a net loss of 282.5 million
Good
on
Lord.
68.6 million in revenue.
66.8 million, not billion.
Look, this is from the machine, so I can't guarantee it, but I did hear this elsewhere. Net loss of 282 million.
I covered in my newsletter maybe 2 or 3 weeks ago the bullish Q2 filings from Strategy, Coinbase, and one other I can't remember off the top of my head. On the surface, they were all very positive, right? Like major beats. But then under the hood, you saw almost all the profit was from their Bitcoin holdings. And it was like a one-time profit because of the rule changes. And Coinbase, for example, which had billions in profits, their trading volume from Q2 2024 to Q2 2025, so 1 year, was only up 5%, right? Like tiny improvement on trading volume. And that in a bull market seems bad. And so if they're the market leader in the US, and I think they certainly are, then it does make sense that these other exchanges like Gemini would be suffering even more. And Coinbase was making most of its cash on either holding Bitcoin or in holding other people's Bitcoin. And they're like the biggest holder of spot Bitcoin ETFs, right? So I don't think Gemini has any products like that, do they? Of just like holding institutional
custody. Yeah, I'm not sure.
I'm not sure. Not like Coinbase.
Either way, though, I think you're right that when they do finally IPO, they'll do well. They'll make bank just because of the structure of the markets right now, as we discussed.
Yeah, so they're gonna do the classic crypto project run, which is have a bunch of insider coins, let the market moon initially, and then just sell out your coins for the next 5 years into all the demand.
Yeah.